Ian, can you hear us?
I can hear you, Jim, loud and clear. And you're looking pretty good, too.
Likewise.
Much better than normal, actually.
Do you want to kick it off, Ian?
Yeah, thanks. I'll try not to be so rude. So welcome, everybody. As I mentioned just then, we're only on audio today. It is being broadcast and it is being recorded. It would be good if speakers could identify themselves before they speak, because obviously we can't see them. And let's see how we go for a 7-hour call. So first I'd like to welcome Jake Green from Grant Thornton to his first meeting. Welcome, Jake. And Rajesh Gopinathan from Tata Consulting. He's come all the way from Mumbai today. And also James Luke, who's participated before by telephone, but hasn't been here in person, I think, from Ernst & Young. I think that's all my public announcements. Jim, over to you.
Thanks, Ian. Welcome here in Norwalk. I believe we are being videocast, so the absence of seeing a screen doesn't mean you're not on the screen, so just keep that in mind. Welcome here to Jake Green, who I think has participated in, or I'm not, to Robert Morgan, who has participated in London in the past and is participating here today. And so with that, I think that covers the attendees. Let me turn it over to Cullen and to Henry. Cullen, I think to you first for any administrative items.
Sure, I can start. And Henry, since I can't see you and I can't know if you're trying to get my attention, I'll make a few brief announcements and then you can add anything that I miss. As part of the meeting materials for today, you should have received an updated summary for the July 2014 meeting. As several TRG members requested, we updated that summary to be consistent with some of the more recent summaries that included, for example, a staff interpretation about some of the issues that have been discussed. The next TRG meeting is scheduled for July 13th, and we ask stakeholders to submit any implementation questions for that meeting at least 1 month in advance, if not more. A number of the questions that we have received recently do not involve black and white answers. They involve issues that will require some judgment or, in some cases, significant judgment. I think realistically for the staff to be thoughtful and helpful in papers and to be able to give the TRG members at least a couple of weeks with the papers, particularly at a busy quarter end for many of the folks around the table, we asked for about a month of lead time. It's hard to believe, but today is our 4th TRG meeting, and we are quickly approaching the 1-year anniversary of the board's issuing the final revenue standard. From our perspective, this has been a successful process in that it has allowed the boards to understand quickly what some of the issues have been in the standard and to be able to respond to those in a fairly quick manner. As we sit here today, we only have a few submissions to the TRG that we think are broadly applicable that have not yet been discussed at a TRG meeting, and we plan to discuss all those issues in July. As we think about approaching this 1-year mark, we are considering announcing a date at which all submissions should be made to the TRG for discussion at a future meeting. And then there'd be other ways that the boards could be helpful during the implementation phase of the revenue standard. We have not made a decision about that, but we would be interested in your feedback after the meeting, both the TRG members as well as any interested stakeholder, as to whether that makes sense and what the right timing is. Henry, have I missed anything you wanted to cover?
Cullen, thank you. No, I think you've covered everything. Maybe just one point just to add. We've obviously got a fairly full agenda for today's meeting. And, of course, the group is slightly larger than it was at the last meeting. So I think, obviously, we'll see how we get on. But I think key thing is obviously trying to be incremental in your comments into the discussion so we get a good chance of keeping time. Thank you, Colin.
Okay. Henry, I'm not sure if there's anything you can do about it on your end, but we're having a little trouble hearing you. I'm not sure if it's us or you, but maybe we can try to look into that. If you could go find one other.
Is that me personally, or did you hear Ian?
No, not you personally, Henry. One other note on minutes. Did anyone have any concerns or feedback they'd like to provide on the minutes from the January meeting? I'm happy to take those now or after the meeting if you prefer. Okay. Henry, anyone on your end that has feedback on the minutes?
Not having any indications here, Colin. No, I think we can move on. Thank you.
Okay. So next we'll move to a brief research update. Since the last TRG meeting in January, as you know, the boards have met a couple of times and have made significant amount of progress on some of the concerns that had been raised at previous TRG meetings. And we thought it would be helpful to summarize where we are on addressing those issues and then in particular what our next steps are. Certainly realize that's not news for many of the TRG members, but we thought it would be helpful to stakeholders broadly to briefly summarize at one time kind of overall state of play. And with that, Kristen, will you give us a research update?
Yes, thanks, Colin. The TRG has met 4 times since the issuance of the new revenue standard. The majority of the implementation questions discussed at the first 3 TRG meetings have been resolved at the meeting without any further action needed. However, the boards directed the staff to perform research on a few issues. 2 of those issues, identifying performance obligations and licensing, were discussed at a joint board meeting on February 18th. The other issues, which included a few practical expedients, narrow scope improvements, and the principal versus agent assessment, were discussed at a meeting on March 18th. To date, the boards have discussed almost all of the topics that they had directed the staff to perform research on based on TRG feedback, and I'll provide a brief update of decisions reached as it relates to each of those topics. The only other research project not yet discussed at a public board meeting relates to the effective date of the standard. The FASB plans to discuss this on Wednesday, and the IASB plans to discuss this topic later in April. I'll start with an update on licenses and performance obligations. As I noted earlier, the FASB and the IASB met at a joint board meeting on February 18th to discuss issues related to licenses of intellectual property and identifying performance obligations that emerged from TRG discussions. The boards each decided to propose some improvements in order to clarify the guidance in the new revenue standard with respect to each of those topics. For licenses, the boards decided to clarify the guidance on determining the nature of the entity's promise in granting a license and the scope and applicability of the sales-based and usage-based royalties. The FASB also decided to clarify the guidance on determining when an entity should assess the nature of the entity's promise in granting a license if the license is not a separate performance obligation, and to clarify the impact of contractual restrictions and licensing arrangements. For identifying performance obligations, the boards decided to add some illustrative examples to clarify how the boards intend the guidance on performance obligations to be applied. The FASB also decided to make changes to Topic 606 to address implementation issues about immaterial promises to a customer, application of the distinct guidance, and accounting for shipping and handling activities. The FASB staff is in the process of drafting a proposed accounting standards update for licenses and performance obligations and expects to issue it in the second quarter. The IASB decided that it will develop a single exposure draft of proposed clarifications to IFRS 15. This exposure draft will include the clarifications that the IASB tentatively decided to make at the February 18th joint board meeting, together with any other clarifications that the IASB considers necessary in light of the discussions at the TRG meetings. The IASB expects to approve the clarifications to be included in the exposure draft in its meeting in June 2015. Next, I'll move to an update on other issues, including a few practical expedients and narrow scope improvements. The boards discussed the following issues at the March 18th joint board meeting. The first is the practical expedience upon transition related to contract modifications and completed contracts. The second is the presentation of sales taxes collected from customers. The third is non-cash consideration, and the last is collectability. For practical expedience upon transition, the boards decided to provide a practical expedient that will simplify the accounting for modified contracts at transition. In addition, the IASB decided to provide a practical expedient for completed contracts. As it relates to the presentation of sales taxes, the FASB decided to provide a practical expedient that would permit entities, as an accounting policy election, to present amounts collected from customers for taxes as net. With regard to non-cash consideration, the FASB decided to clarify guidance to require that non-cash consideration be measured at contract inception. The FASB also decided to clarify that when the fair value of the non-cash consideration varied due to both the form of consideration and reasons other than the form of consideration, the constraint on variable consideration would only apply to variability resulting from reasons other than the form of the consideration. The IASB staff decided not to make any amendments to the requirements for non-cash consideration, but directed its staff to monitor the progress of the FASB on this topic. Finally, the FASB decided to amend collectability guidance in Step 1, identifying the contract, to clarify when a contract is terminated and the objective of the collectability threshold. The FASB staff is in the process of drafting a proposed accounting standards update on those topics and expects to issue it in the second quarter as well. The IASB made no technical decisions with respect to collectability, but will decide whether, and if so, how to clarify the requirements at a future meeting. The IASB also decided to incorporate its tentative decisions with respect to contract modifications and completed contracts into the exposure draft previously discussed to propose clarifications to IFRS 15. The IASB staff also plans to monitor the staff's progress on other issues. Finally, I'll give an update on principal versus agent research. After discussion about principal versus agent at the July TRG meeting, the boards instructed the staff to perform additional research around the issues regarding that guidance under current accounting and new accounting guidance. The staff provided the boards with an update about the ongoing research and outreach on this topic at the March 18, 2015 board meeting. In this update, the staff indicated that the principal versus agent guidance requires the use of significant judgment under current GAAP and IFRS, and that those judgments will likely continue under the new revenue standard. While the staff is performing outreach and working with stakeholders to identify solutions to reduce the amount of judgment needed in this area for both current and new accounting guidance, it is unclear whether the staff will be successful in making improvements that will substantively reduce judgment in this area. The staff is focused on trying to make a substantive improvement, but we think it is possible that significant judgment will be necessary for the narrow subset of transactions for which this is a challenging area today. If the boards decide that the alternatives identified by the staff would not significantly help practice for those narrow subset of transactions, the staff will ask the boards whether they want to make some narrow improvements to the revenue standard to clarify the board's intent with principal versus agent guidance. The staff will provide additional updates about this topic at a subsequent board meeting in spring. Henry, do you have anything that you'd like to add?
Thank you very much. No, I think you've covered all areas there. Just to say, on our work on principal versus agent, the IASB had an education type discussion at the last meeting, and our work continues on that topic. One thing maybe I just highlighted is that everything that Kristen has just been explaining in terms of where the board has got to in terms of its discussion on the various issues, we have tried to cross-reference in to the submission log as well. So there are now references to the papers, the board papers, as well as obviously to the FASB's tentative board decision document and IASB update. So we tried to bring all of the discussions together on each of the topics in one single document. That was all for now.
Okay, nothing further here, Jim.
Okay, any questions, comments on the update? Seeing none here, Ian, I think Issue 1 is that one I think you're going to tee up first?
Yeah, that's fine. We've just been told by our communications people that we should talk quite closely to the microphone. Apparently harder to hear than we expect. Don't ask me why. Okay, issue 1 and agenda paper 31, variable discounts. Sean's going to open it up for us.
Great. Thanks, Ian. TRG paper 31 addresses stakeholders' concerns that the new revenue standard is not clear about allocating a variable discount to one or some but not all performance obligations. The issue arises because the guidance on allocating a discount to one or some but not all performance obligations is different than the guidance on allocating variable consideration to one or some but not all performance obligations. The question arises on which guidance an entity should apply if there is a variable discount in a contract. 3 views have been brought forward. View A, those with View A hold that the guidance on allocating variable consideration is considered first, and only if an entity does not qualify under that guidance would it go on to consider the other guidance on allocating a discount. View B is that the guidance on allocating discount would apply regardless of whether the discount is fixed or variable. View C would insert judgment, and an entity would first need to determine whether it needs to apply the variable consideration allocation guidance or the discount guidance. The overarching principle would be looking at the allocation principle to determine which makes the most sense in a given set of facts and circumstances. The staff thinks that only View A is consistent with the new revenue standard. In reaching that conclusion, it notes in paragraph 32-41 or 86 in IFRS 15, it establishes a hierarchy for allocating variable consideration to a portion of the contract. It states that only after the entity considers whether all or a portion of the variable consideration relates to a specific part of the contract would an entity consider the remaining paragraphs on allocating the transaction price. And those remaining paragraphs include the guidance on allocating the discount to the transaction price. With that, I'd like to ask the TRG if they agree with the staff's interpretation and if there's any other questions on this paper.
Okay, thank you, Sean. We'll take comments in London first. Has anybody got any views on this item? Okay. Tony, now just check I make you right. Don't push the button. No. There you go.
Thanks, Ian. It's Tony DeBell from PwC. I think my sense is that I agree with where the staff's got to, that the guidance in paragraph 86 suggests that you look at the variable consideration guidance first. My other observation on the paper, I think, is that the perspective the staff has explained in paragraph 10 is also important, which is to say if there is a fixed component of the discount, so that the fixed element of any consideration, if that is less than the aggregate of the standalone selling prices, you would apply the guidance to allocate discounts rather than the guidance to allocate variable consideration. I think that follows from the analysis in the paper, and I think that's what paragraph 10 is saying, although it's not responding specifically to the question.
Okay, thank you. Any other comments? Do I take it for the lack of comment that most people agree with you, right? Everybody doesn't agree with you, right? Now, I think we've got agreement with you, right? So over to you.
Ian, our connection, we got about every other word you were saying there. I think you were saying that there weren't other comments and handing it over here. Perhaps we can also, I don't know if the connection's on our side or yours.
Okay, I'll just repeat it, Jim. Yes, you were right that we only had one comment, but then we got unanimous support for view A.
And you're coming across perfectly now.
I'm always perfect, Jim.
Yeah, when we want to hear what you say, then it's perfect. Comments here? Agreement with the staff? See some head nodding. Looks like unanimous agreement with the staff on this side as well, Ian. So that's a successful outcome, I guess.
The challenge now for you, Jim, is to do the next one as quickly.
Yeah, material rights. That'll be. Let's see if we can do that.
Okay, we'll give it a shot.
Yeah, you're going to tee this one
Yeah,
up. Yep.
sure. So at the October meeting, the TRG discussed factors an entity would consider when determining whether a customer option provides a material right. So the next paper is a follow-on to that discussion, and it addresses a series of questions regarding the accounting for a material right upon exercise. The first issue in the paper addresses the question of how an entity should account for a customer's exercise of a material right. For this question, the staff think the guidance in the standard could be read to support a conclusion that the exercise is treated as either a contract modification or a change in the transaction price of the existing contract. The second issue addresses the question of how an entity should evaluate whether a material right includes a significant financing component. The staff think that whether a material right includes a significant financing component is dependent on the facts and circumstances in an arrangement. An entity would need to consider factors such as the timing of when a customer is likely to exercise the material right and whether the exercise of the material right is at the discretion of the company or the customer. The third issue addresses the question of over what period a non-refundable upfront fee is recognized. The staff think that the answer to this question is dependent on whether an entity concludes that the upfront fee provides a material right, which of course will be based on the facts and circumstances of the arrangement. If the fee provides a material right, then the fee should be recognized over the expected period of benefit. And if it does not provide a material right, then the upfront fee should be recognized as the related goods or services are provided. So with that, I'll turn it over to TRG for reactions to the staff views.
We'll start here in Norwalk. Observations, questions, comments on issue 1? Oh, Allison. Always miss you in that corner.
I'll try not to make too much noise over here. So with respect to the first issue, our question was, if I've understood paragraph 22 correctly, is that either view A or view B could be reasonable interpretations. It doesn't appear as though it's a matter of judgment in terms of facts and circumstances driving you towards one answer versus the other. So that suggests that there could be two different accounting models that would be deemed to be acceptable. And if that's okay, if that's satisfactory to the board members that you could have entities doing different things, then I think the follow-on from that suggests that it's really more of an accounting policy election for an entity to decide, do we think that accounting for material rights should follow a view A approach or should follow a view B approach? And presumably then if it's material to your financial statements, you would have to disclose that accounting policy election. Is that the right way to understand paragraph 22 in the staff's view on this matter?
Yeah, I think that's fair, Allison. I think really the crux of the issue is how broadly one would interpret the definition of a contract modification. So I think the standard, you could read it either way to suggest that when you have an exercise that literally is a change in the transaction price and there are additional goods and services, so therefore it is a contract modification. Or I think you could read the standard differently to suggest that, well, those additional goods and services were already contemplated as part of the initial transaction, so you simply just have an update to the transaction price at the time the option is exercised. So didn't think it was facts and circumstances based, literally thought you could read the standard to suggest either view A or view B.
Mark, the accounting outcome, though, view A versus view B could be the same in many circumstances.
In many
Is that
circumstances
correct?
it could.
Because modification accounting in many of these types of circumstances could be the same as the outcome in A?
That's right. It could be different in some.
Yeah, but that is not a matter of, so determining how to account for the modification is not a policy election. There is guidance that tells you. Right.
And I think so in thinking about view A and trying to understand, so the accounting conclusions, which I think that a lot of entities do today because there isn't really specific guidance on how to do the accounting when you have an option in a contract. I think that getting to an outcome similar to view A, I think, is consistent with how some companies do it today, but just thinking through how you apply that under the new revenue standard. So if you're saying that it's just a continuation of the contract and then you have a change in the transaction price, it almost seems as though under view A you're saying that change in the transaction price, you're almost accounting for it as a separate contract because you're allocating all of the consideration to that separate, that newly purchased good or service. it's not like a change in the transaction price per se, because if you were to take it through that specific guidance in the standard, you might end up needing to allocate that change in the transaction price across all the goods or services.
That's fair. That's right.
Thank you.
Others? Brett?
Yeah, so we also don't object to the sort of staff's analysis here that view A or view B could be acceptable. It was somewhat, I guess I was curious as to how, with the reference to in BC 82, the notion of a separate and subsequent negotiation between the parties as being part of the what a modification is, whether that caused anyone any concern around defining a modification or defining a material right to be, that was there at the outset to be a modification in light of that language. If that was, I think some in our shop read that and thought, boy, that sounds like there's a separate negotiation happening after the fact. Having said that, I think there's other words that might, as the staff pointed out, might suggest the modification is in fact, or an option that changes the price or changes the goods or services could be a modification. So I wouldn't object. I do, like Allison said, I'm curious as to whether that having two different approaches here is what was the intent, is acceptable. And the other thing I was curious about was whether the same choices would be available for a right or an option that wasn't deemed to be a material right at the outset. So in this case, we carved out some consideration for the material right, and that becomes part of what's in the accounting for the second when the option is exercised. But would the same two choices be available if it weren't a material right, but just a non-material right at the outset, an option?
Well, I had a little bit of the same reaction on modification as you did, and then in our prep session, the staff helped me understand that, because it didn't feel like a negotiation, but I think you do look at other pieces of discussion of modification, and it was sort of hard to argue that it doesn't, just from my standpoint, meet that. At least that's how the staff got me comfortable that A or B seemed to be reasonable in the context of the standard.
You could have an arrangement where the material right is that you get, let's say, a third off of your next purchase or 50% off of your next purchase, but you still have to walk into the store, decide what you want to buy, agree on what the total price is for that, and then you exercise your material right. The other thing that at least came to my mind personally in thinking about the analysis that Mark had put together is, while there are some circumstances where you can get a difference between A and B, like Jim said, there's also a lot of circumstances where you won't. And the other thing is, considering the nature of what we would be accounting for here, I think companies are going to have to apply some practical approach in applying the material right guidance. And I'd hate to say you absolutely must do it. If the standard doesn't specifically call for it, I'd hate to say you absolutely must do it this way, recognizing that I personally think this will be a difficult concept for some companies to practically apply to a large volume of transactions.
Yeah, that was, just to follow up if I could on that, and was wondering too if you thought, because part of the issue with modification is you have to evaluate whether it's in fact at the separate standalone selling price at the time, right? And if you think about that for an option that may be exercised, a year later, am I solving for the standalone selling price at inception or at the time that it's exercised, that modification happens? Because of modification, I would think I would evaluate it as if it's a new contract at that point in time. But here I had an option that was available from the outset. So so it creates by calling it a modification. In fact, it makes it in a sense harder because you've got to evaluate all those other elements of it versus just a separate contract by definition or separate.
But only if there's other items to follow after you exercise the material right, because if the last thing is the material right, then it's whatever you deferred plus whatever the new transaction price is revenue for that item. So you're talking more in a complex arrangement where there might be more to come. But if it's, let's say, a retail situation where it's, buy one, get the second free, or you get 40% off, and then once you exercise it, that's it. There's nothing else to do. It's whatever revenue you deferred plus whatever new consideration is received. That's revenue for this new item done.
The second part of your question, I don't know if the staff hadn't analyzed what accounting you would do if it wasn't a material right, so you concluded you hadn't given up something that was significant, and somebody subsequently exercises it, what the accounting is in that model.
We haven't thought about it, but no, haven't thought about it.
Is that Karen or Scott? Okay. I saw it. So maybe we can get her a replacement one.
We were generally of the view that either view A or view B work. We did have a preference for view A, and don't really like the notion of there being two different accounting outcomes just because of the comparability issues. We also struggled a little bit with whether it was an accounting policy choice or a decision made on a case-by-case basis. And I think what I'm hearing today is that it's a decision you would make on a case-by-case basis by applying judgment that's not an accounting policy choice.
Yeah, I would think that for similar types of transactions, you would apply whatever view consistently to those transactions.
So that it would be an accounting policy. If your policy was modification, you would have to go through case by case, because modification accounting is assess each modification to figure out one of two accounting outcomes.
So that then, I think, the point I was going to make is I think there probably needs to be a little more guidance around this, because it isn't clear, I don't think, from the words in the standard around whether it is an accounting policy choice or whether you are looking at the facts and circumstances in each fact pattern and reaching a conclusion.
Russell?
Yeah, I was actually going to challenge this same thing. I don't. Do we really want this to be an accounting policy election that's company wide? It seems like there is a principle with respect to how to allocate consideration, and that's the objective you're trying to achieve. I get the point that for similar circumstances you'd want to apply the same method, but that's not an accounting policy election. That's to me, that's judgment throughout your transactions and your accounting models. But to me, you want to choose the model that best reflects the economics. I can't imagine that an investor getting into, if this is an accounting policy, getting into this level of disclosure, I can't imagine that that's going to be useful information. So I would just challenge whether or not we want to think of this as an accounting policy election.
I can hear that on one hand, although I struggle if we say both A and B are acceptable, and you have a fact pattern, how you decide which most faithfully represents the economics, without saying, well, for example, somebody says, my policy is A, so I don't go through modification accounting. Does that mean, no, in some circumstances you must still evaluate whether it's a modification, or can you have a policy that says every material right is effectively a new transaction? So I'm a little fuzzy as how we would say this is something other than.
I could see certain transactions being one view and other transactions being another, and both cases a better reflection of the economics for those circumstances. So that's why I would struggle with a company-wide policy election.
Yeah, and maybe that's broader than I was thinking, saying company-wide you must say everything is A versus similar transactions, similar policy election, not unlike, I think depreciation accounting, there isn't some thing that says you must have a company-wide election with respect to depreciation methodology. But I think if there are choices, applying those consistently is sort of what I was thinking of as the sort of the election piece of it. Brian?
I think maybe to follow up on what Russ said and maybe try to re-articulate it, I think first in our own shop, there were divergent views on whether it was view A or view B, and really no objection to what the staff had to say. some concern about paragraph 23, because if you maybe take Russ's situation, if I have a enter into a contract and has a material right, and then as part of exercising that material right, I also add goods or services to the arrangement, then this kind of, notion of I'm going to have a policy or something like that seems difficult, because there is a modification. But if I'm view A, do I say, well, the material right, that's not part of the modification, and I account for that separately? It just seems unwieldy in that circumstance.
Jim?
It's a policy election, or whether or not it is based on some material rights when you exercise them are modifications, and some material rights are not a modification. So I think if that's the case, then I think we need to clarify that.
So I thought what we were saying, but staff correct me if I'm wrong, is both A and B are reasonable interpretations, which would seem to me to say somebody could say my policy is to never treat these as a modification. Someone else might say my policy is to treat them as modifications. I guess what I'm hearing is some might say within their policy election, this category of transactions, so for this, wouldn't have to be divided by subsidiary, but let's just do it that way. For this subsidiary, they treat all of their material rights as modifications. This subsidiary that does something else treats them as, view A, as extensions to new transactions. And I think you see that with other areas in accounting where there are policy elections, that it could be divided by subsidiary or type of transaction. Are we saying something other than that?
No, that's exactly what we were saying, or trying.
That's what I think we're trying to say, Jim. Scott?
I have to admit, I thought View B sounded like the one that the literature most led me to, but View A is the one that sounds like the accounting that everybody does, and I'm happy to see that View A is still possible under the new standard. I don't know that I have described it as continuation of the contract. I almost think of what View A does is it treats it as a new contract. And you never worry about the other stuff that was in the original contract. Once you have the material right, you allocate what was sitting there as allocated to the material right, plus the new consideration, all to the new goods, as if it is a separate contract. I actually kind of liked that, because I think that's what you would have to do for a non-material right. I think because we've decided the right wasn't material, it's as if it didn't exist in the first contract. So if somebody exercises it, that has to be a new contract. I'm not sure what else it could be. So I kind of liked View A because you get the same accounting, whether it's a material right or a non-material right. That is, when it's exercised, you just go ahead and account for that thing on its own. So I think that makes it easier. And as for the policy election, I think the last round of discussion clarified the way I thought it was supposed to go. You make a policy election that applies to all transactions that are similar. But conceivably, you might think different policies should apply to different transactions, just as companies apply different depreciation methods, LIFO, FIFO. There's all kinds of things that a certain segment of transactions is treated one way and another group is treated another way. This seems to be just one of those.
Others here? Greg?
I had a question on issue 3. Do we want to go to issue 3, or do we want to take him and see? Okay. Is that okay? Okay. I just had a question for the staff. When we were thinking about issue 3 on how to account for a non-refundable upfront fee, I was wondering if, by analogy, we should be applying the logic, the conclusion of the analysis to other non-refundable upfront fees. I mean, in this context, it's an activation fee with respect to a discussion of material rights. But in the IT industry, there are many different types of arrangements that have significant upfront fees, IT outsourcing, implementation of a SaaS arrangement where you have to do, a significant amount of work may still be considered an activity, not a performance obligation, but has an upfront fee to get the clients, started and to recover the cost that you incur to initiate an arrangement. And I was just, when we looked at this question 3 and the conclusion, we had that question. Should we be thinking? Was the staff thinking that this would apply this type of the accounting for non-refundable upfront fees should, by analogy, apply to other types of upfront fees, or was it just this type of an activation?
No, I mean, it was an example that we used, but I would think that the same logic would apply to all non-refundable upfront fees.
So we should think of any type of an upfront fee. We should assess it to see if it conveys a material right.
I think that's right.
In terms of whether the activity or the work would have to be reperformed if the client went to a different provider?
Potentially, yes.
Okay.
Yep.
Okay, thank you.
But that's not to say it is for a material right.
Right.
It might just be that you got paid 10% up front and the rest over time or something.
Okay. All right, thank you.
Mark?
Yeah, I didn't know we were going on to the other issues. I think I agree, or we all agree with issue 1, but on issue 3, are we, in paragraph 29, are they saying that isn't, it might not be a material right, or it is a material right if a $50 activation fee on a $100 month contract, or is there a chance that's not a material right?
I'm sorry, Mark, for your question is the $50, is there potential that it could not be?
Yeah.
I mean, I think in this particular fact pattern, I think it likely would be, but I guess you'd have to go through the evaluation to think about, okay, well, the customer life in this example, it was 24 months or whatever it was. Is there does the fact that the customer stayed on that long, is there some indication that that $50 was one of the factors that made them stay that long? You could evaluate qualitative type of factors like that too, but I think in this particular example, because the upfront fee is such a significant portion of the monthly $100 fee, I think you probably would end up with a conclusion that it is a material right.
Yeah, I mean, the fact that they stay for 24 months, maybe that comes into, material rights only the first few months, or, you amortized over that, but we were a bit, we didn't know what that meant. And the other question that came up, and I know you're not trying to answer it here, is straight lining that $50 fee over the life of the customer life acceptable or not? I assume straight lining's okay, or you could come up with a method where, like the example in the standard, where you estimate the standalone selling price of each renewal period and decline it somehow, I guess.
Yeah, I mean, I guess if you concluded that the $50 was a material right and that expected period of benefit somehow aligned with the customer life, then I would think that it would be appropriate in that case.
Ian, let's turn it over to you on issue 1. I know we'll go ahead, Rita.
I was just curious if you could explain for a franchise contract for, let's say, a restaurant or a hotel company, when would you recognize the revenue? How would you, is it the initial, because right now I think they do it up front, and you're saying that you do it over time?
Are you talking the franchise fee?
Mm-hmm. To get the franchise?
Well, that would more likely be covered by our forthcoming licenses exposure draft. In general, franchise rights will be symbolic intellectual property, and therefore any upfront franchise fee of, say, $1 million will be recognized over the franchise term. That's generally how it's going to work under the model.
Darryl.
I just wanted to make an observation after hearing all the comments now, and really this kind of goes back to, I think, what Brett was referring to early on. And maybe it's semantics, but it just seems unusual to me that if we have a contract that includes a material right that was negotiated by the parties on the front end, and now all that's happening is the customer is exercising that right. It seems, without any further negotiation, it seems a little bit strange to refer to that as a contract modification. Now, maybe what we're talking about here is simply, the accounting outcome or mechanically how you handle that, as opposed to really what you call it. but it just seems strange to me to refer to it as a contract modification when the parties haven't negotiated anything new. One of them has just exercised what was already granted to them. Maybe somebody could help me understand that a little better.
Daryl, I think, the way the standard describes a contract modification is a change to the transaction price or the goods and services that are going to be provided. So I think a literal read of that would suggest that when a customer exercises an option, they're getting new goods and services are being added to the agreement, and there's additional consideration being provided. So I think that's the context in which people that are the modification view, that's how they think about it.
There are an awful lot of people that seems like in this room and outside this room that think view A is the right answer, and I think it's probably fair to say in a lot of cases view A will result in the simpler accounting. But for the reasons that Mark mentioned, the staff didn't think that someone absolutely couldn't read the standard as view B. In fact, at least one person has expressed that view. But what I said a few minutes ago I think is important to keep in mind is that although we're talking about this sort of as an accounting policy, in some ways it feels theoretical to me because how one will actually go about accounting for material right in some cases, it's going to be difficult. And the actual journal entries one goes to do to affect this, if the standard doesn't absolutely preclude view B, then I'm not sure that that's in anyone's best interest to do that.
Ian, over to you.
Okay, thanks. Thanks, Jim. So we're doing issue 1. Anybody got any comments on issue 1? Christoph. Hang on. That's the picture. Okay. You've not got.
Hi, Christopher Fitton from SAP. I agree with the staff that both interpretations can be derived from the standards. I've got to admit I struggle with the contract modification idea for 2 reasons. Number one, in the example with that service A plus option for service B that is in the paper, the amount of revenue I recognize for service A depends on whether and when the option for B is exercised, which is somehow ought to be. And if I then think that the option could be transferable, then the customer could transfer the option to someone else, and if someone else comes to exercise the option, then we certainly cannot speak about a modification of a contract because certainly it's a very different customer. We cannot discuss that it's a continuation of the contract because it's a different customer. So again, it doesn't only depend when and whether the option is exercised, but who exercises the option. All this can be avoided if you view the exercise of the option as a separate contract, which is very similar to the accounting you get under A. And that's why I have some preference for A, but got to admit not that the standard would allow B.
Ian, the way the audio is working here is literally we're getting unintelligible discussion. I don't know if there's any way to improve the audio.
Okay, we'll have a look. A lot of shuffling going on here. Christoph, would you maybe just a bit closer and make your points? You made your points again?
Yeah. Major points, I said I struggle with option B, although I think it isn't a valuable interpretation of the standard, because in option B, the amount of revenue I recognize for service A in the described example of setting service A an option for service B would depend on whether and when the option for B is exercised. And on top, if the option is transferable to a third party, then it depends on whether it's the original customer who exercised the option or whether the customer transfers the option to someone else who then exercises the option. That's why I have a preference, as I said the last meeting already, to take a view that the exercise of the option is a new contract, which I made result in the same accounting that
much more drawn to view A. It seems as though view A is consistent with the illustration of, for example, customer loyalty points. And I think view A would be generally much easier to apply to customer loyalty points than view B would. We don't object to the idea that view B is possible. What we would object to the idea that view B was the only possible answer. We think view A is very important and likely to be needed in many circumstances. The main extra thing I'd like to point out is that view is very much on the basis that we are looking at something that we've already confirmed is a material right, rather than actually being something that should be seen as part of the goods and services under the core contract. Now, you might look at the rejection of the and conclude that anything that appears to be optional under a contract is automatically not part of the goods or services in a contract. I think that would be too simplistic and perhaps dangerous. There can be items that appear superficially to be optional, but in reality are not optional. There can also be all kinds of penalties associated with cancelling optional items that have the effect of making them not optional. So the question of whether things are actually options for additional goods or services or part of the core deliverables under a contract, I think is sometimes quite a difficult question. But I'm happy with the rejection of UC for those things that are material rights, and that they really are additional goods or services.
Ian, you come across quite well when you speak. I think so far, almost every other speaker, we get about half of the words or less. So perhaps, and I don't know what to do about that other than perhaps at the end of the discussion, Ian, you'll have to just summarize where you're at.
Yeah. Okay, thanks, Jim. We get a report that the people listening to it here are hearing it okay. So I don't know. You never know with these things where the fault is. So I think the first solution, I'll try and outline what he said, which if I recall was tended towards view A in your considerations. You conceded, though, that view B is possible, so that you're more or less agreeing with the staff recommendation in that regard, but you don't feel that it would be reasonable to use view C. Not for additional goods or services. Okay, it's a fair summary? Okay, good. Andrew Buchanan.
Thank you. Andrew Buchanan, BDO. I think similarly in our discussions, we were much more drawn to view A than to the other ones. As with the paper, we pretty quickly rejected view C. And when we looked at view B, it seemed that while we could read the standard that way, it did seem in some respects a slightly curious way to read it. That, however, was in the context of the example which is in the paper, where there doesn't seem to be particular interdependency among the different components that are there. There's something being supplied, and then there is an option for something separate to be supplied. And so all that happens here is that the customer has an option or an incentive to enter into a subsequent contract for the provision of the second service. So in the example in the paper, we struggled a little to see that it had very much to do with it genuinely being a modification of the original contract. It was something separate that you happened to have agreed on at inception, so it was already there. If you change the fact pattern and as has been suggested, you do sometimes get contracts where there are options, things where there are references from one component to another. You might get a slightly different fact pattern, but then that needs to be analyzed in the context of its own rights. However, I think it's an overall position. While we wouldn't rely on you, we wouldn't necessarily have any kind of preference. We, as I said, much more drawn to view A as the appropriate approach in this place, although we understand we can't entirely rely on view A. I don't know how to sign up there.
How did you get that, Jim?
No.
No? Okay. let me take you through it quickly. Again, a preference for view A and a ruling out of view C. I think that view B in the context of the example given would be a bit curious. So however you could vary the example and you might then come to view B. So overall, a preference for A and a less preference for B. Got it that right? Okay, thanks. James. Thank you, James White. Without wanting to reiterate what we said, we're in a very similar position to Andrew's point of looking at view A with a preference over view B, and likewise also ruled out view C. I think my discomfort, though, is really, do the board want to leave this as an accounting policy choice? Listening to the conversation in the US and some of the conversation here, it seems as if some people are veering towards the facts and circumstances analysis. Now, looking at it as an accounting policy. My thoughts were that if you say that A and B can be read into the standard, then effectively you've got an accounting policy choice. I think the board wants to tighten up on it.
Ian, would it be possible to take maybe a 10-minute break and we both try and reconnect? Now, even when you're speaking, we get about every other word or every third word. We're not sure if it's our connection or on your end.
Let's come back at... Okay, that's fine. Let's come back at 20 minutes to the hour.
Okay. Thanks.
Thanks.
We do that.
Okay, let's see how we go. Now, I think you got Christopher's message, Philip, and Andrew. I'm not sure if you got James's message. Is that correct?
Correct.
Okay, James, would you like to give it another go and we'll see?
Okay, well, in quick summary, what I was saying, I think we got to a very similar position as Andrew. We had a preference for A, but we did not rule out B. We could see how you got to B. I think my biggest discomfort is I'm not sure whether the standard is saying we have an accounting policy choice on A or B, or whether it's a facts and circumstances decision I should be making. And I'm not sure what the boards are leaning towards on it, and I think that clarity should be there. If we were to follow facts and circumstances position, I think some guidance would be necessary and hard to interpret, and whether you go down view A or view B. And I think that's my greatest discomfort.
Okay, Jim, did you get that one?
We got about a third of that.
I know. Let's try one more, Jake, and then see what you get out of that.
By the way, I'm told that the IASB website is actually clear. I don't know if there's any possibility of broadcasting it from the website onto a microphone here, but as an idea, I just...
Frankly, I've got no idea what you're talking about.
The sound on the webcast is fine.
line, people can hear what we're saying in this room.
Can you see us now, Jeff?
No, but we're going to see if we can somehow get the audio off the website.
Okay, so should we just wait?
Well, keep going, and we can, you don't need to summarize each person, Ian. You can summarize at the end as well.
Okay, thank you. Jake, go ahead.
Hopefully the third you can hear is the sensible third. When we discussed this in-house, we had differences of opinion, both view A and view B, but those that held view A held back really quite strongly. The idea that you have given away some rights and obligations in the original contract, and that somehow just because someone has exercised one of those rights modifies that original contract made some people feel very uncomfortable. But before coming to a final view, we wanted to see some examples of when view B might give a different answer to
Brett, the internet's on a delay.
I would certainly have QA following the logic in BC82. I would also accept view B. It just seems to me that a contract with an option in it gives you different rights and obligations to a contract with a commitment in it. And I can certainly think of other scenarios where I would require attention if an option becomes a commitment. So I will accept either of those, but it seems to me that the key point coming out of this discussion is it's an accounting policy question, and it is how do we think about that. To me, the observation that we would account for economically similar transactions in the same way should be unchallengeable. I have to say, I would certainly expect that. There was a question about how interested people would be in making detailed disclosures or reading detailed disclosures if people did different things for different types of transactions. And one of the key thing to focus on is really whether or not it makes a difference the way that the entity counted for that type of transaction. I guess the key way that might make a difference is that under view B, you may or may not have future catch-up adjustments to revenue. And it seems to me that if somebody was making a choice as to whether or not to turn on or turn off those cumulative catch-ups to revenue, that would be quite an important thing for them to explain in their financial statements. If that was not having a material effect on their financial statements, I would probably be quite relaxed about the level of disclosure. So maybe I feel less of need to specify in this, because I think it would be dealt with disclosures in cases. If the board wanted to be more specific about this, I think there could be risk of unintended consequences. It would be important to think quite carefully about the interaction with accounting for contract modifications generally to make sure that you weren't accidentally leaving open the possibility that you could have unintended changes.
Ian, the sound is actually now worse than ever. What I'll propose is, unfortunately, it seems like it's not getting better. Perhaps we each hold a discussion here. You hold a discussion there. We can have one of our staff persons watch the website, compare notes. If I guess it'll be an interesting test if we're in agreement without watching each other, a really good proof that the standard gets you to a common spot, particularly with the staff analysis. If we're not, we'll either have to try and bring it back in the last half hour, 45 minutes, and if we can, figure out there, or we'll have to bring the issue back to a subsequent TRG meeting. Is that acceptable, Ian?
Yeah, that's fine, Jim. So we'll carry on. We'll continue broadcasting and recording so that you can watch. And then we'll have to communicate with each other, in about 3 hours or so to see how we're each going and decide on final action.
Okay. And we'll carry on here. We'll just disconnect from the line, but one of our staff people will watch the discussion.
Okay, thank you.
Yep, thanks.
All right. Well, now, what I think I'll do is open all the microphones, seeing as we're not connecting to Norwood, and that can make things a bit more free-flowing. And we'll continue on, and as Jim said, staff will keep an eye on it, and we'll see whether we're in agreement or disagreement. And if we're in a disagreement, we'll have an attempt later this evening to talk about it. And if we're in agreement, we can go ahead. Now, Brian, just one question to you. You said most important thing is it an accounting policy?
Okay. Issue 2.
Well, we teed up all of the issues. I just on issue 1 real quick, I just think it's important to point out that regardless of your view A or view B, I think oftentimes you're going to arrive at the same answer under either view. The situations you wouldn't would be is if you find yourself going through the modification guidance in paragraph 2513B or C, and at least in the case of 13B, that says that you don't have a separate contract for modification purposes and that the goods or services aren't distinct. So I think in that case, you'd have to argue, if you're going to get to a different answer than you would under A, you'd have to argue that these optional goods and services aren't distinct from the other goods and services in the arrangement. So I don't know how easy of an argument that is to make, but it would seem odd to say that goods or services that may or may not exist, they're completely optional, that those aren't distinct from other goods and services in the arrangement. So that may be another way to think about it. But point being, I think oftentimes under A or B, you're going to arrive at the same answer.
Any other comments, issues 2 or 3? Or 1, I guess. Nope. Should we move on to the... Well, I guess let's summarize this. I think many, what I heard here, couldn't hear there, but in Ian's summary is I think many thought the accounting outcome in A was perhaps the one most consistent with one current practice, many thinking that was also the most sort of logical accounting outcome. Some struggle with how it is a modification, but if you look at the words broadly, seems to indicate that. I do think might be worth getting a reaction from board members as to intent, sort of along Darrell's point. We can do that offline, but I think in any case, the accounting between A and B are very similar, except for the circumstance that Mark just indicated. I'm not sure how frequently that comes up, that you have a material right for a good or service that is somehow not distinct, because it would be a little bit odd at that point that it's optional. So it seems like in any case the accounting should be resolved for the vast majority of exercises of material rights, unless I'm missing something. Okay. Issue 3, I think, is that you, Sean? Okay.
So this is in relation to TRG paper 28 and consideration payable to a customer. We had a preliminary discussion about this issue at the January meeting, and the staff has gone back and researched the issue further. There's three questions that are raised in in paper 28. I'm going to tee up issue 1 and 2 together for your discussion, and then we'll do issue 3 separately. And while I acknowledge issue 1 and 2 are separate, the reason I want to do it together is interpretation C in issue 1 includes a variation on the view of the customer. So I thought it made sense to talk about it all together. Issue 1 addresses the question of which payments to a customer are in the scope of the consideration payable to a customer guidance. That is, to which amounts paid or payable to a customer should the entity determine if they are receiving a distinct good or service, and if that distinct good and service was acquired at a price that exceeds fair value. There were 2 views put forward in the original TRG submission. The staff has learned through outreach about a third view. Briefly, the 3 views are interpretation A. Under this view, an entity would assess all consideration payable to a customer. This view is most aligns with current U.S. GAAP. Under interpretation B, entities should only assess consideration payable to a customer if it relates to a revenue contract or combined contract under that guidance. In addition, this interpretation would look to the modification guidance to identify situations where maybe the contract may not be legally modified, but it's economically modified, and thus should be considered under the consideration payable guidance. Interpretation C is an expansion of interpretation B. Under this view, an entity would also assess consideration payable to a customer for goods and services that are within the distribution chain of a revenue transaction. The distinction between B and C is illustrated in paragraph 19 of the memo. The paper outlines the arguments for each interpretation. So for the sake of time, I'm not going to go through each one of those. However, the staff concluded that view A is most consistent with the new revenue standard. The staff acknowledges that view A may not always yield economic results in circumstances where an entity cannot determine the fair value of distinct goods and services. But I want to highlight 2 key reasons for coming to that conclusion. If you look at BC 257, the staff thinks it makes clear that the board intended a broad view. And I'm going to read these 2 sentences. The amount of consideration received from a customer for goods and services and the amount of any consideration paid to the customer for goods or services could be linked, even if they are separate events. For instance, a customer may pay more for goods or services from an entity than it otherwise would have paid if it was not receiving a payment from the entity. Based on that paragraph and also discussion with FASB board members leading up to this meeting, it seems like the intent was to have interpretation A, which is no change to existing GAAP. Issue 2 asks whether the consideration payable to a customer guidance relates to customers in the distribution chain, or should it be more broadly reflective of any customer of an entity's customer. The standard is clear that the guidance does apply to those in the distribution chain. However, the basis for conclusion uses this term customer's customer, and then it says, for example, and gives an example of a distribution chain. So some think with that term, customer's customer, and then indicating the distribution chain is just an example, it could lead to a broader interpretation of who is viewed as the customer. Those that mention this often mention some sort of agency-type relationships as an expanded view. In the paper, paragraph 25, there's an illustration of a agency transaction. We had gotten a few questions from TRG members on this. I just want to clarify. We were really focused on the revenue that the marketing agent would recognize and focusing on whether or not that would be the 55 or would you net the $5 coupon that you're paying to your customer's customer. That's just to clarify. The staff thinks that the use of the term customer's customer was just a plain English use, way to describe the concept, and it was not intended to imply that other customers outside of the supply chain should be considered. With that, I'll turn it over to TRG members for discussion on issues 1 and 2, see if they agree with the staff views or if there's other interpretations that we should have considered. Brett?
On the first issue, I think it's fair to say we don't agree with the staff's view. While that may be an articulation of what current GAAP says, we believe that the revenue standard defines a unit of accounting as the contract. So that puts us more in a view B camp. And at the end of the day, this is really a scoping question as to what transactions need to be evaluated to determine whether, in fact, they are for distinct goods or services, or in fact a return of consideration to the customer. And in fact, if you think about the definition of what distinct means, and distinct in the context of the contract, that we think all that sort of suggests that what we're really evaluating is whether, in fact, a payment in the context of that contract, again, considering modifications to the contract and combinations of contracts need to be evaluated. That it's too broad we think it's too broad a brush too broad a stroke to look at every single customer relationship that exists for a given company. So that puts us in a View B camp. If there's concern that somehow opens up the door to abuse, then maybe some sort of a caveat that would suggest that it's not just contracts in the current contract, that it could be in say, for example, an anticipated contract or something that's a transaction that lacks sort of commercial substance, absent the entirety of the arrangements with the customer. So, for example, if you had a situation where an entity made a payment to a potential customer, but didn't yet have a contract, sort of in anticipation of a kind of pay to play kind of situation, that might be scoped into the need to evaluate it. But that, whether if I happen to have a transaction with a customer 10 years ago, or maybe some entity that I acquired had a contract with that customer, it just seemed like that was way too broad a scope. So we were more in the View B camp there.
Brett, my concern with that view is it seems like you would rarely be having to consider this issue then. Because if you're just talking about accounting for the contract at hand, then that would seem most of the types of transactions that you have to consider today you'd never consider, because it's not directly with the customer, or it's not part of the same contract.
I guess I don't agree with that. Most of the transactions we evaluate today intuitively, what people look at are situations like slotting fees or payments that are made to the customer, or payments that are made to the customer's customer, such as coupon drops after the fact that affect the transaction price of that. They see it as affecting the transaction price of that particular contract, right? In other words, it's a change to the contract.
So you think a payment to the customer's customer would be part of this contract?
Yeah, would be changing the economics of this contract, right? That's how right.
But that view, so I can understand that, but then that does seem a little bit broader than just the contract at hand. So if you're my customer and then Rita's your customer, if I make a payment to Rita, I certainly think that should be considered in the overall arrangement, but the contract I have is just with you, period.
Right.
So it seems like while you have that view,
But how does the consideration payable guidance, and the next issue is defining how broad that is, whether it's how narrowly you interpret customer's customer, but let's stipulate that we're talking about a customer in a distribution chain, right? So I'm making a payment to, say I sell cars to dealers, and then the dealers, I give cash incentives to the buyers of those cars. It's clear in the standard, I think, that is the reduction of my revenue, right? But so those, if that's what we're talking about, that's where the consideration payable guidance ties to. But you would say that payment to the customer isn't in the same contract.
I certainly think it's part of the economics of the arrangement, right. But my concern is if you were to say you only have to think about consideration payable in the context of a contract you have with a customer, then in this sort of three-way example of I'm a consumer products company, you're a retailer, and Rita's a consumer, I have a contract with you, that's it. So what happens between you and Rita is essentially not my business.
But now if you're making a payment to
But if I make a payment to Rita, I think that should be considered in this overall arrangement, and yet the contract that I have with a customer is just between you and I. So I'm afraid if you look at it in the exact way that you're looking at it in terms of UB, that some people would look at that and say, well, what I did with Rita has nothing to do with the contract between the two of us.
I think one thing that might help here is I do agree with Brett that the contract combination guidance, if it was entered into at or near, should pick it up. I think we're the struggle there, and what Cullen is getting at is that, like, if that payment is made somewhere 6 months down the road, it's no longer at or near the same time. The modification guidance seems pretty clear that while you might think it's economically linked, it seems like it has to be with that customer. Like you're making a change to the contract with the customer. That's where I think it struggle to get picked up.
Yeah. I mean, again, we're talking about, just to be clear, we're talking about a requirement in the standard that's all about evaluating whether a payment is for distinct goods or services, or at least in part a reduction or return of the customer's consideration, right, that you got in. So what scope do you think is meaningful to look at there? And I guess I would submit that it's the contract itself. I'm trying to evaluate that. And in fact, how do I evaluate whether something is distinct in the context of a contract when you're telling me that I have to look at transactions with every customer, every potential customer who was ever a customer of mine, and make that evaluation? It's hard to figure out how to apply a model to that.
Well, I agree with that. I think that's the difficulty, is you can't, in many cases, it was very hard to figure out what that payment was for. And so if you go and say, well, I have to clearly indicate that it's related to the contract, you're sort of in this circular thing. As I have a payment, it's unclear exactly why I made the payment. Was it that transaction? Was it a future transaction? Or was it some other thing? I think if we end up saying, well, you do it at the individual contract level, we're going to end up having then to define the very issue that Cullen talked about, is what is the contract, and does the contract extend beyond the contract between the customer to include the customer's customer, or was it really the board's intent to change consideration payable to a customer?
I guess we talked about materiality and being an issue with, in terms of companies having to document something's not material. I guess if you think about I'll use an accounting firm, a Big Four accounting firm. I mean, almost everybody is a customer of ours at some level. So what you're really saying is every payment we make to buy a distinct good or service, we should in theory document why it isn't in fact a return of someone's consideration in part. And and I think that again, it just comes back to let's be real. No one can actually do that. I think it's going to.
So you're saying no one is actually complying with GAAP today?
I'm saying people come up with ways of sizing it, right? Of evaluating, looking back certain amounts. I think so. Again, it comes back to my mind at least. What's the unit of accounting we're evaluating here? And we want to sort of create some sort of a scope that is operational, I guess, to my mind. I think creating a requirement to evaluate situations where I make payments that don't lack commercial substance absent the arrangement.
Or retaining that, because suggesting that this is a change, I think what the board was saying is we didn't, so it's not creating an obligation. It's retaining what companies are required to do today.
Well, I think now the difference, though, is we have a definition of customers, and so that's new, right? And
right. You were making it sound like an incrementally hard thing to do, and I take your point that it can be challenging. It's not unprecedented. It's existing gap. Bunch of cards. I'll start with Ross. We can just go.
I was just wondering if you took the interpretation B approach, which is what you're proposing, how would you deal with the situation where so Jim's my customer. He's been my customer for years. He hasn't been my customer for the past year, and I just give him a check for $100,000. So and then 2 days later I sign a contract, but it's not there. Would you? Yeah. So in under interpretation B, what I hear you saying is it's only literally what's written down in the contract. Is that what you're saying?
Well, I think I was suggesting I'm going to look at payments that lack commercial substance absent the contract.
Okay. So how is that different than A? Because what A says is all consideration payable to the customer. So I know your point about the Big Four and you lease from clients, right? So that in your mind would have commercial substance. In A, you would conclude that is not a payable to your customer. So what I'm trying to figure out is how your observation is not interpretation A.
I don't think what Brett is saying in terms of how it should be applied is significantly different than what the staff has in mind with Alternative A. I just think what he's saying is that as articulated in Alternative A, he believes it's opening up Pandora's box in terms of the applicability of that, and the fact that in his mind, and I sense other people's minds, that it would be very difficult to open up that box and determine and be able to assess all payments made to customers. But I think from a practical standpoint, he's not saying that what we're doing today in GAAP is something that should be changed. He just is questioning how it's being articulated in A. And quite frankly, what you're challenging, Jim, is Brett's assertion that alternative B is a better articulation. So I think we're in violent agreement, but just disagree on how to articulate it.
Let's get to that, because I think the staff was trying to say that GAAP didn't change in this space.
So Larry, in the example that Russ just gave, where Russ makes a payment to Jim and there is no contract, I wouldn't want someone to look at that arrangement and say, there's no contract, I'm done. So the reality is you do actually have to evaluate that payment, and whether you want to say it's all or most or whatever, I don't know, but it can't be just related to a contract, because I think everyone's in violent agreement that the payment between Russ and Jim would be something to consider in terms of a reduction of revenue.
So I had it interpretation A as basically the same thought that you have today. And if that's different, then we ought. But I think that's maybe we ought to think about is, do we want to change in the philosophy today? And if not, how best to articulate?
Well, the difficulty is is that at least several Big Four representatives at the table are shaking their head no. So I think we have a challenge in terms of what the word should say.
Yeah, I mean, when we talked about this, we weren't in necessarily B or A. We agreed. I think what A is trying to say is what current GAAP is. Where we struggled a bit in the discussions we had, I mean, there's obviously areas where you can abuse B, so we didn't necessarily agree with that entirely. But when it says the only way to determine if consideration paid to a customer is linked to the revenue transaction is to assess it under this standard, I think that you could have contracts that have, that are totally, they're not linked at all. The two parties within the company didn't talk to each other, and they have nothing to do with each other. If somehow there was an agreement, or they were negotiated together, they were linked somehow, there was a random payment, and even if there's a $100,000 payment to a customer, you got to figure out what it's for, and if it's linked to the revenue transaction, then you got to deal with it. So I think we were probably closer to A, without going to B, but we were thinking about like audit services. Think about the FASB. Your IT service provider might subscribe to your thing. Do you guys go out and document that that's at fair value, put in your revenue work papers that was at fair value? No, if they weren't negotiated together at all, and if the service provider comes up and says, I'll do this, and you give me some free, free access to the online website and everything else, well, that's different. But if they were totally negotiated separate, I don't think you have to go document that that's at fair value if they were never linked together. So
So my sense is we weren't trying in A, Mark, to say that. I get you could read the words and say, well, every transaction. Yeah, I understand that things that on their face are unrelated. You already have enough evidence. It's intuitive. I don't think we were trying to go that far, but we could.
I mean, we stay at the hotels of our clients. We fly the airlines.
I understand. Again, we weren't trying to say things that on their face are not related.
Well, I mean, the way that you have to assess it, I would think that controls would have to be in place. That's why I thought A went a little too broad.
I could also see a situation in which, not in the audit space, because it might be an independence issue, but somebody says, if you buy my products, I will give you discounted airfare for the next 10 years, that you might think about whether there's two things.
No, you would have to, those would be linked, I would think, because they were negotiated together.
Karen?
This comment maybe is directed more to the international stage than the U.S. stage, so I will apologize for that since they aren't on the phone. But I think it is important, certainly important from a Canadian perspective. I think everybody agrees we would like to get to view A, but there are not any words in the standard that really support getting to that view. And you get there by using the basis. Not everyone imports the basis into their national GAAP. Canada doesn't. We also don't translate it into French, which creates a whole other problem. So I think it would be helpful from an international perspective if we did actually import some appropriate words into the actual standard itself. The other question that came up, and this is not international related, it's generic, is whether if it seems pretty clear from the words in the standard that the unit of account is the contract with the customer. And then if we're bringing in a broader view of payments or consideration paid to customers as part of this view A, is there anything else that is contemplated that should be included as you do the assessment of the accounting that is implicit as opposed to explicit?
Scott?
Well, View A certainly is current practice. We do believe that's what the standard says today. And I'm surprised to hear all of the comments that suggest View A is really hard. We've been doing it for years. I don't think it's that hard. Let's take Russ Hodges' company. I suspect every entity on earth is a customer of Russ's company. And when Russ's company buys airfare or hotels or car rentals or food or cleaning supplies, I don't think that they feel a need to document everything. I think they know that they went to Walmart. Okay, they don't go to Walmart, but I think they know that they bought it through the same distribution chain that everybody else buys it through and paid the same amount that everybody else does. So the analysis is really easy. We paid fair value. We got distinct goods. If the problem is that we think somehow that saying it's View A means we have to write that down every time, that sounds like we have a problem of over-documentation, not a problem with we don't know how the accounting standard is to be applied. So, we've been doing this for years. I don't think it's been a big problem. I think it does put some discipline in the process. If you have a transaction that is really separately negotiated with a customer where you're not buying through a standard distribution network, and you actually do negotiate the price, and it's a unique transaction, well, then I think View A kind of puts some discipline in the process. You got to at least think about whether it's linked. That being said, I said at the prior meeting that I thought the standard said View B. View B is where I'd go with this standard. I wasn't concerned about the consideration payable to a customer's customer that might get added later, simply because 606.10.32.25 or 70 in the IFRS standard, the lead-in, it says consideration payable to a customer includes cash amount an entity pays or expects to pay to the customer or other parties that purchase the entity's goods or services from the customer. I thought it was pretty clear that cash payments that go around the direct customer but to an entity further down the distribution chain are consideration payable to the customer. I wasn't really worried about whether the agreement to pay consideration to the customer's customer was there day one or got put in place day 90 when we were trying to encourage sell-through. It's still consideration payable to a customer's customer, so I didn't think that View B was going to miss anything. And quite frankly, I think what we're dealing with here is that a reasonable application of View A and a reasonable application of View B are really close together. Unreasonable applications of them are very far apart. So, I kind of think the answer to this is don't read this trying to justify an extreme application either way. Read it with a view to trying to get a sensible answer, and views A and B aren't too far apart.
Allison?
The only thing I just wanted to say is that our perspective, as we had expected based on the board's discussions, and certainly it's captured in the basis, that the board wasn't intending to change the consideration payable to a customer guidance, so we would have expected practice to continue, not suggesting an expansion. If people have read Interpretation A to think it's an expansion somehow, I don't know that that's what we were thinking. We were more expecting that practice would continue consistent with how it is today, but appreciating that this view B had emerged in practice in terms of people thinking that there is supposed to be a change, so that the boards did intend for there to be a change. I think that's the reason why we're discussing it today, but our thought was more towards continuing current practice, and if that's view A somehow, however it's articulated, I think that's what we would think is the right answer.
Brian?
I guess our perspective would be somewhat similar to Brett's in that I think if maybe part of the issue with this paper is the articulation is that there is no change in gap. And I guess we believe very fundamentally that there is a change in gap. Existing gap creates a rebuttable presumption that any payment to a customer needs to go against revenue unless you overcome it by meeting certain conditions. We think the standard is based off a principle which may be similar to if there was a principle underlying existing gap, similar, but nevertheless it is a principle that should be applied in a principles-based way as opposed to creating a rebuttable presumption that now I have to come up with a lot of evidence to overcome that. So I guess maybe it's a different articulation of UA or UB, but something.
You think that principle in this is different than what that rebuttable presumption was driving at? Leave alone for a second the audit documentation or the internal control documentation issues. Is the principle that you articulate here different from what we were striving for in existing gap?
If I were to try to articulate what I think the principle is the notion that if in substance you have a transaction with a customer, there's an adjustment of the transaction price for a revenue transaction, that should be a reduction of revenue. And that may, getting hung up on whether the contracts were at or near the same time. I think there's room within the standard to say, well, let's say I sell somebody something and 9 months later I enter into a transaction to buy something from them at above fair value. I would say you need to consider whether or not the substance of that is that there's embedded in there a modification, which is a reduction of the transaction price from the original revenue deal. So to me, that is what the standard says and what you should do, but that's a principle as opposed to a rule, which I think View A feels to me like a rule.
So Brian, is another way to say what you're saying that you think current gap allows you to just default to an answer of they must be related, so reduce revenue?
I think people do default to an answer. In a lot of cases, that's a very sensible answer, like slotting fees and things of that nature, but I've seen in practice other circumstances where, for example, someone sells semiconductors to somebody, and then 9 months later they license intellectual property from the other party. There's most definitely an identifiable benefit to that second transaction. The question is was there also some sort of adjustment to the transaction price? But today's gap, the rule would say, hey, unless you can show me convincing evidence that the fair value of that intellectual property is what you purport it to be, and we can all debate about what enough evidence is, but if you can't, I can default to just recording that as negative revenue.
So we had a very similar discussion, at least in the prep session I was in, and it does quickly get into, well, why would that be a problem? You can get into what level of evidence. Do you need VISO? Do you need objective evidence, or what evidence? But, if it is, you got it, and you can go out and get a determination of value, which the standard would seem to tell you is sort of any excess above that, and maybe there's a lot of reasons you wouldn't think there was. It wasn't even, in Scott's example, you do everything under the sun, and you went out and, bought an airline ticket. People aren't going and saying, well, go find the compelling evidence if on its face you're paying fair value. So we were struggling with how much of this is about determining value versus how much was, the other issue.
I think what what the board's adopted was a principles-based approach, and then to suddenly say, well, but in this one thing,
there's a rule.
It's a rule. That just seems not quite. If we're really going to apply principles, let's apply principles. It should, in most cases, still yield the same outcome, but some of the rules-based outcomes that we have seen in the past would also not be justifiable. That is, if I get a distinct good or service, I should record that. But if in the same transaction, I gave the customer a sweetener because they're upset about, a prior transaction where I sold them something, then I should account for that too. And we have to be good accountants and take care of that.
I think there's an important thing that I heard Brian say here that I'd want to make sure everybody, including listening, seemed to catch. I think there's been some concern from people that haven't liked interpretation B, that Brian's example where you have a contract, then you have another contract 9 months later, wouldn't be considered linked, period, because they aren't at or near the same time. So they wouldn't be considered part of the same contract. What Brian said was important is if you have some sort of sweetener there that is, let's say, recouping bad performance on the contract 9 months ago, you should treat that non-substantive portion of the contract as effectively a modification of that original contract. Therefore, when you think about it that way as really a modification of the old contract, then you now have both the modification of the old contract and this new contract that happened 9 months later, and you then do get caught up in the contract combination guidance. So there isn't an out there. So to me, that was an important distinction that I know we had talked about at least a little bit internally as staff, to understand that just because you're saying the contract combination guidance would apply doesn't give you an out if you effectively modify that original contract at the time you enter into the new one. So I don't know how clear that was, but I think that's a very important point that we should think about.
So I think Larry was right. I think most of us are in violent agreement on the outcome. It's getting that into the right set of words. Jim?
First of all, unlike the previous question, we talked about where if you literally read the words, the exercise of material right was a modification, you said doesn't really matter because we get the same answer. Here, a literal reading might get you a very different answer, depending on how you read these two options. So I think it's important that maybe it does need clarification one way or another. I do think that, to the point that Scott just made, that the principle here is when do you combine contracts? Why doesn't that apply broadly in terms of the criteria where otherwise view A gets you kind of a rule that seems to go beyond what the principle is here as to when you combine.
Would one possibility, just tossing this out, would be a re-articulation of this staff paper rather than, firing up the rule-making machine?
The summary, the summary for the meeting will, can reflect that. The views in this paper were the views submitted by a stakeholder who's sitting around this table. The staff summary will do our best to try to communicate what I think we're all saying here, which is it doesn't seem like the board was trying to change GAAP.
And I think we can, again, we'll have to see the words. I think we can do that in a way that says GAAP was striving for something similar to, your point about whether GAAP had a presumption that you would now need to actually go figure out. So you can't just default to reduction of revenue. You actually now need to go figure out, is it related to the old contract or a contract you're going to sign tomorrow, or is it related to the thing that you're buying separately? So I agree with your point of, that presumption in GAAP, which when we say not intending to change, I think that's an oversimplification of, at least in my view, is the outcome might be very similar in 90%, but there is a tweak there, at least in my mind. Brett?
Yeah, sorry if I'm redundant here, but just wanted to reiterate one point and make sure everyone appreciated this, which is the evaluation that one needs to go through when you identify one of these payments is to evaluate whether it's distinct, right? So capable being distinct and distinct in the context of a contract, like, for whatever words we end up with, and once the changes are made to the standard around separation. But one of the things I struggle with is how do I make that evaluation if I don't know what contract I'm talking about? So that's what puts me back into a contract-based model and looking at the contract. But maybe a related point, we talk about contract combination guidance and the standard being somewhat narrow and only related parties at or around the same time. And I wonder if in fact maybe it's too tightly, too narrowly defined. That in my mind, at least, I think about combinations of requiring combinations of contracts where there's like economic linkage, where they've been one's dependent on the other, and again, that standard says what it says, but I wonder if that's the tension we're feeling here is because the combination guidance is so narrowly defined, and that there are these payments that are going around that maybe you have this sort of desire to want to put them into the same arrangement because they're linked.
Tom?
I'm not against having this trying to be resolved by having the staff write up some sort of view about what this discussion is. But I think we have to be very careful, or at least think about this. The conclusion can't be we're not just trying to change GAAP, because in the international world, I'm not sure that they have knowledge of that. So it has to be not change GAAP and then put some words around it so it works more effectively.
Yeah, I think that's a good point. Russ?
So I'm optimistic we can potentially come up with something at the TRG level and not have to do standard setting. But I think what we're talking about is combining of contracts. And I think what's in the standard about combining contracts is two revenue transactions, whereas this is not. The other one is not really a revenue transaction. And so I don't. And I think that's where we can talk about how, because I think what we're saying is the existing literature talks about is the payment for. Is it substantive for actual real goods or services? And I think what those of you that are saying B are saying the same things as A, which is the principle should be, is if you are making payments and not receiving appropriate goods or services, think really hard about it being a consideration payable to a customer. So I think we're in broad agreement. I think that's consistent with the philosophy we have today. And I think we just need to talk about how best to articulate that so practice doesn't have a drastic shift in work with no drastic shift in results.
Others? Sean?
So we'll move on to the last issue in the paper. Excuse me. So issue 3 addresses some concerns that have been raised about the timing of recognition of consideration payable to a customer. Stakeholders point out that consideration payable to a customer can be variable consideration. Therefore, the requirement.
And I see Brett over there too doing the. I don't think we realized we had moved beyond issue 1.
Oh, okay.
Or I think we thought maybe issue 2 was. Now we're done with issue 1, and maybe now we're moving to issue 2. Even though I know you teed them up the same. That's okay.
Go for it.
if that's okay.
Yeah, I had teed up issue 1 and 2 together, but
so
issue
discussion
2
on issue 2
was really just that the customer's customer notion was a shorthand, and did not really believe the standard is clear that the distribution chain notion is what the view of the customer is.
Allison.
Shall I go first? Well, after reading the description in issue in question 2, I think that's an answer that we can accept and not object to. However, whether that's really clear enough in the standard, I think we were not as convinced. Practice today is mixed. I think I'd mentioned that last time in terms of how entities and the fact pattern, similar to the chart that's described on page 11 or depicted on page 11, where you've got an agency relationship where the agent may very well be providing an incentive to the end consumer or the end consumer in this example. There is mixed practice today in terms of whether companies view that as an expense or whether they view that as a reduction of the transaction price, because they view today's guidance, they think about, well, the customer's customer, that if they're an agent and their direct customer is the principal, then the principal's customer is the end consumer, so it is the customer's customer. And it doesn't seem from the words in the standard that has really changed. So I think companies could take a look at the standard without the benefit of this discussion and have thought that they would be required to continue the same accounting, meaning you wouldn't expect to see any change in the presentation between periods before adoption of the new standard versus after adoption of the new standard. And so I think that's where the question comes up, is like, okay, well, maybe that's the view going forward, but where are the words in the standard that tell us that it has to be that way?
I have to admit that Sean had to educate me as to exactly what the distribution chain is in the context of this paper. But that having been said, the guidance on consideration payable, specifically talks about, a customer. It uses that many times. And then the definition of a customer is a party that, obtains goods or services from the entity. And an agent, sort of by definition, does not, right? The agent is not obtaining goods from Brett and then selling them. It's the agent is just facilitating Brett transferring his asset to Jim's asset. So I personally think the standard is clear in that respect.
I think the counter argument to that, it's taking the analysis through a little bit of a different perspective, is someone could say that if you are the agent, then your service, your good or service that you're providing is an agency service, and that if you're choosing to discount that agency service, that is the good or service that you're providing to essentially the end. You're providing that to the principal and that effectively along to the end consumer, because you are the party that's bringing both the principal and the end consumer together. So I think viewing this, well, we need to think about that the underlying good or service in the transaction. I think those who are serving as intermediaries would view their agency service as the thing that they are ultimately discounting, and that's how they view the customer's customer. Language is kind of tying all of that in. I know Brett had some similar thoughts.
But in, say, my example of, Brett selling his asset to Jim and I'm acting as the intermediary to facilitate the sale, Brett may never have any idea what my fee is. Right? I mean, I may have offered Jim a discount and you and Sue or not, or I might have, tripled my discount this month. Brett may have no idea about that. He may not even have the right to know that.
That's right. I think that happens in today's practice. But again, so we're continuing to just make the argument about taking it through customer's customer, but there are lots of companies that view, if they're in the agency role, they actually do view the end consumer as being their customer, that they've got two customers for business purposes. For accounting purposes, we may have defined them, or maybe we may be defining them under the standard as being the principal, but they actually view the end consumer as being a customer in their arrangement as well. They describe it that way in their marketing materials. They would be disclosing it elsewhere, perhaps in their public filings in terms of programs and incentives that they provide. And so this, I think, interpretation under Issue 2 would be an accounting result that may or may not always be consistent with how companies view the incentive programs that they provide.
Scott?
I actually felt a little whiplash after I read Issue 2. In Issue 1, it seemed like the staff was really stretching to get a broad interpretation of when you would reduce revenue. And then in Issue 2, the staff said, don't you dare stretch to get a broad interpretation of reducing revenue. So I was surprised, and I reread the conclusion of the staff's view in Issue 2 a couple times to make sure that I didn't misread it. I think this is going to give a silly answer. The marketing agent can change its arrangements to gross up revenue and expense, right? The marketing agent can just say, okay, I'm going to charge $50, but everybody gets $10 off. And, wow, well, we just got a bigger amount of revenue offsetting expense. Obviously, it doesn't affect operating income or anything, but I think this is going to give a poor answer. And I believe most of these marketing agents, I mean, let's face it, the biggest one is Groupon, the one that we all know from probably having dealt with them in some way. I think these marketing agents view, in reality, that they have two customers. Yes, they get paid in one set of money, but I think they view themselves as providing services to the merchant and to the end consumer. And so if they give money to either of them, that is reduction of revenue. I think that's the mindset in most cases. So I find this analysis to be rather interesting. Whoever you think you're the agent for, as long as you give money back to another party, well, then you get to gross up your revenue. I think that This is not going to give representationally faithful accounting. And I would have read the standard both because of the customer's customer language and also because of the issue of exactly who is your customer. I think they're both your customer. I'd have gone with the opposite answer than you've got here.
Can I ask a question on that? With the current guidance being very clear that it's around the distribution chain, I'm just curious why that isn't an issue today, because I struggle with articulating how that's different than what it says in the new standard.
Exactly. I think that today's guidance and what it says in the new standard are the same, and my understanding of what most companies do in this situation is reduction of revenue for the $5 coupon.
But it is the distribution chain notion that's an existing gap.
Well, it is the distribution chain notion, but it's also a matter of who are your customers. And I think companies either, look at it as we've got two customers and we are refunding money to one of them, or the notion of distribution chain is considered very broadly. We provide marketing services to the principal, the restaurant, the store, or whatever, and they're able to take those marketing services combined with their goods and services that they have in the store or in the restaurant and sell them to the end consumer so that the transaction with the end consumer is sort of all in. When we think about revenue recognition, there's a lot of things that go into making a sale, and marketing and selling efforts are one of them. And in this case, we've just outsourced those marketing and selling efforts, but it still seems part of the same transaction with the end consumer.
I didn't necessarily get whiplash on this one. I actually thought it was somewhat aligned. I think the key here in issue 2 is that the merchants are not necessarily aware. I guess they could know that there's promotional programs going on out there, but I think if it's clear that the amount you're giving to the ultimate customer is a reduction of your agency fee, and you've negotiated with that merchant that that's what you're going to do, and I think they would be linked. And just like in the first issue, since those are linked, I think you would have to deal with that. If, on the other hand, I'm giving a general promotion to get people to my marketplace, I'm a mall, and I give someone a $10 mall bucks, and they can go to any store they want in there, I don't think that's necessarily a reduction of my lease payments from the mall owners. I think that customer's not actually paying me any money directly, and I don't think you combine those two contracts. So I think this is workable, and I just like similarly say I'm a travel agent, and I say I run a promotion, and I'll give you $100 off your next trip, and you come in and you can sign up for Carnival Cruise, you can go to Italy, you can go anywhere you want. I'm going to give you $100 off. I might only get $5 in commission. I'm trying to get people to come to my marketplace so I get more business in the future. It sounds more like marketing. I think we can make that distinction. Clearly, if I say to Carnival Cruise Lines, increase my my agency fee, and I'll go run a promotion where I give everyone $100 off your cruise, that would be linked, and that would be different than if I am simply just trying to get people to my marketplace. So I think this is workable. I assume the one question I had, 27, didn't seem to conclude, but I assume we're concluding that the way I just described it there, but it didn't necessarily conclude in paragraph 27.
Yeah, we did not go into the notion of the contract to be combined. We thought that was clear, that if it could be an agency relationship, but if it was clear that the agent knew or you were
linked, it was linked.
Then, yeah.
Yeah, this is a surprisingly difficult question, and we, quite get strong emotions on this question, and it affects presentation of income statement ultimately for companies, and there's a lot of companies in the agency space these days, right? And I think we have to be clear, because we're describing the paper what is maybe a classic selling agent situation, right, where you have a principal and you have an end customer. But there are a lot of agency situations where it's say a purchasing agent, like I don't know, I'll use some ticket vendor might sell tickets and collect a commission from a customer. So in that case, it's clear their customer is actually the end consumer. They're a purchasing agent, not a selling agent. I think in a lot of cases it may not be clear whether you're selling or purchasing agents. You're somewhere in the middle. So I think the way I think about this, way we think about this particular question is, if it's clear it's not your customer, nor your customer's customer, and there's no economic linkage, picking up on Mark's point, that I haven't committed to the promise to do this to my customer in their transaction, then I think we could support this view of it's really a marketing expense there. There's no linkage per se. There's no direct linkage to my customer transaction. But again, I think the struggle with this question is many of those entities see, to Allison's point, see them as their customers. So, so I think that's where we land, is we could accept this answer if in fact it's not your customer and it's not economically linked. And I think bringing it back to the first issue, there's clearly a connection point here, right? Because the broader you scope that dimensions that first issue, the more chance you have of having payments that in fact might end up having to be scoped into that and would get you to potentially to contra revenue. So.
Brian. Others on this issue? Issue 3?
Are we sure? All right. Issue 3 addresses concerns about the timing of recognition of consideration payable to a customer. Stakeholders have pointed out that consideration payable to a customer can be variable consideration. Therefore, the requirement to recognize consideration payable to a customer as a reduction of revenue at the later of when the related revenue is recognized or the entity promises to pay, either explicitly or implied through customary business practice, may not be consistent with the requirement for an entity to estimate the amount of a variable consideration to which it is entitled for transferring goods and services. This issue was previously discussed in January at the TRG meeting as part of Paper 14 on variable consideration. This paper outlines a different view on the interaction of the consideration payable guidance and the variable consideration guidance. The staff thinks that the two pieces of guidance do not necessarily conflict because not all consideration that may be variable qualifies as variable consideration. Paragraph 32.7 or 52 in IFRS 15 outlines the instances when an item is variable consideration. If the variable consideration is not explicitly stated in the contract, it may still be variable if either the customer has a valid expectation arising from the entity's customary business practice that it will accept an amount less than the stated price, or 2, other facts and circumstances indicate that the entity's intention at the inception of the contract is to offer a price concession. The paper then illustrates an example where a planned coupon drop may not be variable consideration, and that is, one, it wasn't explicitly stated in the contract. The customer does not have a valid expectation because it's the first time that they're thinking about doing a coupon drop, and 3, the entity's intention when entering into the contract was not to offer a price concession. In that instance, an entity would follow the requirements for consideration payable to a customer and recognize a reduction of revenue at the later of when the revenue is recognized or the actual coupon drop is made or the promise is made. So with that, I'll turn it over to TRG members for discussion on whether they agree with the staff's view and if there's other interpretations that we should have considered.
Allison?
Over here in the corner, going first again. So it was interesting, paragraph 32.7, we hadn't read paragraph 32-7 quite the way that it's been described in the paper. I think that we had thought that paragraph 32-7 was, again, just trying to help identify what is variable consideration. We had thought that variable consideration under the standard would be thought of as and interpreted fairly broadly, which I think is actually consistent with, if we go back to the very first issue we discussed that went very quickly on variable discounts, that's a very broad interpretation of what is variable consideration. So I think when, thinking through the analysis, I could see how someone could read it that way, but that's certainly not the way that we had approached this particular question. And in fact, if you just think about what the principle is in terms of determining the transaction price when you're supposed to be estimating the amount that the entity expects to be entitled to receive, I guess we would have anticipated that if a company, absent the conflict that we thought we'd identified in the standard, we would have thought that an entity that has an intention, but maybe it's not yet been communicated, but if they have an intention to be offering an incentive, that the principles in the standard would suggest that you shouldn't be over-recognizing revenue, just waiting for that formal communication to happen with your customer, which seems to be the result that you would get from following the staff's analysis. So I think that that's I think that we came out again feeling like, oh, well, we wouldn't have read the standard to get to that conclusion. I think we would still have thought that there appears to be a bit of a conflict in terms of the timing of when you recognize the variable consideration based on the guidance later on that talks about recognizing it at the later of when revenue is recognized or when it's promised to the customer.
I know there'll be judgment here. Do you get a sense that the example we outlined there is kind of an extreme one where they never have offered a coupon drop, it's totally brand new, but that a lot of things are going to actually get scoped in because scoped into the regular variable consideration guidance because they do have histories of providing discounts or rebates. So you're not going to there's going to be limited circumstances where you actually would follow the timing of the consideration payable to customer guidance.
I think that's hard to say and be terribly definitive about it because companies are introducing new products all the time, and the nature of the incentives may very well be contemplated at the very beginning of the launch of a new product. So I think it's hard to say that it would be limited. Mm-hmm. Do I think it's every single transaction? No. I mean, there's lots of precedent with particular companies and their customers in terms of the incentives that they might offer. But there certainly are circumstances with new products where a company may not have a history of doing the concessions. So I guess I'm hesitant to say, oh, this is just going to be a very limited population, because we've had enough examples presented to us that makes us think that might not be the case.
Brett?
Yeah, we found it somewhat interesting that this is the only place in the standard that I'm aware of, at least, that requires there to be a communication date to do accounting. You know, there are obviously other places in GAAP and IFRS, the U.S. GAAP and IFRS, that have that sort of model, but it seemed a little bit in a model where the fundamental principle was recognize revenue for the amount you expect, as Allison said, to be entitled to have a scenario, any scenario out there where there was an intention to offer a reduction of my transaction price, in this case perhaps by coupon versus price concession, but any situation like that where you say, well, you can't record the reduction in revenue unless you happen to prove that it's an implied practice. And so you create the problem is you create this sort of model where we're having to debate whether it's an implied practice or not. And entities would say, well, I always give a discount, but I don't give a discount that much. This is an incremental discount. In this case, I'm going to require there to be a communication date to do an accounting. And again, how often it will come up, I guess we'll see it. But we do see situations under today's practice where people wait for a coupon drop to do their accounting, which is what today's GAAP says. It's a later of model. So the standard, in my mind at least, the standard I think has this sort of, it does create this anomaly, and I think it just puts pressure on as I said, on the point around implied practice. It puts pressure on defining what variable consideration is. And if with a clean sheet of paper, if you had no timing guidance in that section on consideration payable, just gave you geography guidance, I think we'd all say, well, okay, well, the model is record revenue for the amount you expect to be entitled to. So we wouldn't. Companies said, my intention is to offer these coupons right after year end. I just haven't gotten around to communicating it yet. I think we'd say, well, the right answer is to reduce revenue. So that my problem here is there's sort of what I would like the answer to be and what I think the standard says, and there seems to be somewhat of an apparent conflict.
There is, I agree, a little bit of a challenge. It's expect to be entitled to. Mm-hmm. So intent might come in some respect because you are entitled to all of it. And so when you get into expect to be entitled to, until you've actually made the commitment to say I'm not going to, you may have actually been paid the full amount of revenue and collected. And it's my discretionary choice to give it back versus other aspects, unless, for example, you have a history and then the negotiation with the customer is something different, that I will provide price support. So I think that's at least part of the tension here. Scott?
I thought the staff's analysis was very well put together and was a very articulate and a good way of thinking about how the standard works. I've been troubled by how to take into account things like discretionary or possible coupon drops or incentives because of the fact that the contract says we get 1,000. Yes, we're considering that we might accept 950. So when do you take that into account? I think this paper does a very good job. It basically says you take it into account if either the customer has a valid expectation that you're going to take 950, Or you actually change the contract to say you're going to take $9.50. The earlier of those things that happen, that's when you adjust your view of the transaction price. I think that actually makes a lot of sense, and I think this view works.
Greg?
Just to echo what Allison and Brett said, we kind of looked at it the same way. And while I would agree with Scott that I think the guidance leads you to the conclusion, the concern that we had is that it potentially opens the risk of some type of manipulation of revenue recognition, because like in our case, using the same fact pattern, if I had knowledge that management intended to commit a rebate or a right to return or a price reduction as of 12/31, but was not communicated to the customer until January 2nd, I'd reduce revenue today as of 12/31 based on that intent. In this case, the guidance suggests that you could wait. Management intent is interesting, but if there is no valid expectation or the client doesn't have an expectation or whatever it is, you sit there and you wait. I think that isn't, in our view, is inconsistent in some way with the guidance that says you should reflect the transaction price to what you expect to be entitled, because at that point, the way I look at it, based on management's view, the amount we expect to be entitled is less than it would be on January 2nd. So that's a concern we had, which is similar to what's been raised.
Russ?
So I just want to follow, make sure I understand the tension point here. Is it, Greg, you help me, I think I understand, is in the event the company had committed to do it, let's say on January 15th, and so there was an internal control policy, you need to have a certain level of management to make the commitment, and that wasn't done until January 15th. But before you issued your press release, would you say that's a follow-year event and not a reduction in revenue?
I think I looked at facts and circumstances that exist, at that point to see if the revenue and the receivable that we would have recorded as of 12/31 would be materially impacted as a result of that decision.
So what I'm getting to is
I think the answer to your question is it depends. Yeah. So if Greg normally has a practice of issuing,
I'm just focusing on this exact fact pattern, right, which is on paragraph or page 13. What I'm trying to get at is your concern about disagreeing with the staff's analysis of the example on page 13, because the staff has focused on communication as the key, because you're not always committed till you communicate, rather than you're saying, well, once management has made the decision, communication's perfunctory. I'm trying to get to, is it the level of is it the degree of evidence you need to prove you're committed that has you frustrated, or is it something else? So same fact pattern. Do I have the right page? Yeah. Same fact pattern. It's just the management with a relevant authority does not commit till January 15th, and you communicate January 20th, both before the press release. Would you push it back or not?
But, it's interesting because we didn't talk about this part of it, but there's a subsequent events question here that's sort of unanswered, right, in terms of whether this is a recognized or an unrecognized subsequent event. But putting that aside, I mean, to me, it's the arbitrage between when a company has decided what its intent is,
right,
decided, whatever that means, what board-level approvals, whatever that constitutes in the company's case, versus when it's gone and communicated that to its customer. That's the arbitrage we're talking about in my mind.
Right. So the staff has put forward a position that says you are not committed until you communicate your commitment. And what I hear you saying, some of you are saying is, no, you should be, you are committed when management has, with the relevant authority, has decided. And I'm trying to figure, is that the issue, or is it something else? And I think what you told me is that's really the tension point.
Yeah, Russ, I think it's putting, communication, you're putting, it's a commitment in my mind. I think when we talked about it, it's like, well, what does communication mean? And so I don't like the idea that, the customer, if you're a retailer, a big consumer products manufacturer, and you sell to Walmart, Walmart has a valid expectation. You're probably going to drop some coupons because you've been doing it for years. It's sort of, when are you committed to do it?
You
never told Walmart you're going to do it, but you're
right. When are you committed? It seems to be the real question here.
Brian?
Sean, I'm going to have to apologize. There was absolutely almost very little in this paper I liked. But
all right. I take it personally.
But I still like you.
Thanks.
I guess I was viewing this, part of my issue with this paper was maybe the way it was characterized, in that here you have somebody selling into a distribution chain, and we're suggesting maybe that entity's specific history is that they don't have a history of coupon drops, but they exist in an economy, in a world where that is customary. And so I would be looking at it more holistically, like, based off these facts, I go, really, there isn't variable consideration there? And we're getting too hung up on the particulars and the chronology of events about how this coupon drop came into existence. I just think I would be more inclined to look variable consideration holistically, and based off this fact pattern, I'd be like, whether you had a history or not, in the big boy world, you probably should have taken that into account.
Jim?
This seems to say, except in this situation where if you haven't communicated it, then you wait until you actually make that communication. And I could see a lot of situations, particularly at the end of the year, somebody pushes a lot of goods out the door. They have an intent to add a coupon, but they don't do that until the first quarter. And that's going to leave a bunch of, the auditors in a very difficult situation where they point to the words in the standard and said, we didn't communicate it. We recorded all that revenue, even though they expected they were all going to receive something less than that.
Jim, I hear that. Isn't that the model today?
Well, it might be the model today.
I'm not suggesting.
I'm just in terms. What the question is, here we've got an articulation of what.
Yeah. No, I know. I'm just, in terms of being able to audit or sort of subject to abuse, I think the words that are taken in terms of communicating that offer were pulled from existing GAAP.
And how would you audit? How would you audit the intent?
So all I was getting at was
communication and past practices, I imagine.
Right. What if we are all agreed that it's supposed to be the amount you expect to be entitled to, and you should take into consideration the intent of management to give back to the consumer in various ways, what level of evidence do you need to understand and audit management's intent? The staff has said you need communication. Others have said, no, don't need to communicate. You just need management with the relevant authority, whether that's the board or whoever it is. And so that's really the tension point, and we ought to decide, because I think Rita will say what's most important is everyone does it the same, right?
Rita, you got your card up.
You don't want some companies to say, let's wait until you communicate, and some companies don't. But maybe, what would you prefer?
My preference would be intent, but I don't think that managements can do it the same because they don't understand what the actual result's going to be. In other words, you intend to sell something for a price, and if the market doesn't accept that, you make a contingent adjustment based on external factors. And so, but you're saying you want to capture that in revenue, and I'm saying a lot of times that's just an expense. But
if management has decided they're going to give $5 back, but they haven't told their customer yet they're going to do it,
I want it early.
You want it when management's decided.
Right. But I also recognize a lot of times when you say management, this could be an automated computer auction, right?
The company's decided, however they decide.
Well, I guess 2 quick points. When we were doing outreach on this and talking to some on the preparer side, they thought that the operationality of intent was going to be incredibly difficult, because at what point do I say I really intended? People talked about, do I go to the board of directors? Is it, certain things, is it a VP? And we also, the staff, observed that we think there's just as much room for manipulation on the intent side. Now, there's the good news, right? You're saying, well, I'm going to over-recognize revenue, but if I'm wanting to manipulate this stuff, then this quarter I intend to do this, and next quarter I intend to do something else. So it seems that there's manipulation either way, potential.
Scott?
My last point is exactly just what I want to mention. I was at the EITF table way back when this language that got picked up was decided on by the EITF, and the concern was in part what was just discussed. You got a good quarter, you come to the end of the quarter and you say, there's a chance that we may need to do a coupon drop or offer an incentive next quarter to help with sell-through. We better reserve for some of the cash we have already collected that we might give back. And the concern I think the EITF had at the time was manipulation, and what the heck is that liability I'm setting up? I don't owe anybody. I haven't committed to anybody. How does that meet the definition of a liability? Now, I think you can get around that by saying you never should have recognized the revenue in the first place, perhaps, and call it a deposit liability or a refund liability under the auspices of the new revenue standard. That was harder to do under the old literature. But I think there was absolutely a concern for manipulation. If you say, book an amount based on intent, well, what level do you need to book that liability? Is it a 100% decision? We're definitely going to do it? Is it's probable we're going to do it? Is it more likely than not? Is it reasonably possible? What's the level that gets me to book a liability to give money back to a customer when there is no customer that I have actually told I'm going to give them money back? That was, the concern that led to dropping in that recognition threshold. And again, I think the thought was liability recognition. When have we actually gotten to that point? So there was certainly a concern about manipulation in that way, and about, now we need to specify a threshold. Maybe we can co-opt a threshold that's in the standard if we want to do that now under the new guidance. But that was something that I think people were very, very concerned about.
Part of what I'm trying to figure out is that people just disagree with what we put in the standard. So is this an interpretive issue, or just open it back up and get rid of the criteria the board established in the standard? That's part of what I'm struggling with. Robert?
I'll phrase it this way. At least from a user's point, the standard needs to be applied broadly. There needs to be quite a bit of judgment applied in the specific circumstances. A lot of these things are turning on circumstances. The example we're giving, frankly, we were given here is contrived. It's a very specific one. I think it's particularly important for gaming, because we've mentioned gaming several times. My reaction to this is that the preparers around here and the auditors are having a hard time getting the right tone, the right rules. Brent was talking before about too broad, and yet I'm sure you were to me you were describing one. You said you too, but you were describing one as far as I thought it was. So I think your challenge is to get alignment on how you're actually. I don't think the words are wrong. I think it's how you're supposed to be reading the words, and I think there's a lot of concern about the audibility of some of this.
Brett?
Yeah, just maybe a point about intent, which is I think the standard already is replete with intent, and I mean price concessions included. So, and I think to go back to existing GAAP is a little bit dangerous. I mean, I think you have to be careful, right? Because today we don't have a model where we record revenue based on, it's got to be fixed or determinable and reliably measured, whatever the words are for IFRS. So we're already in a different model here. We're now recording revenue based on. So I guess the only thing I was raising was this sort of point around the tension it creates around, well, is it a price concession I'm giving the customer, or is it a coupon drop, or is it consideration payable? And do I really want to create a model that gets to different, we can argue all day long around how much, when intent should matter and when I should change my measurement based on intent, but the standard already has intent built into it. And so, I appreciate Scott's points around the concerns that may have been there in the past, but I just, as we think about it now, is that really and to Jim, to answer your question, maybe it is a little bit of, boy, I wish the words were different. I think the way the staff have analyzed it, I can understand it, and it makes sense in light of the words in the standard. I just don't know that. Yeah. So.
Allison? Yes. The only other point that I was going to make, it is maybe, Brett, what you were saying. The way I would describe it is, this particular aspect of the model seems to be focusing on communication in terms of when you should be recording a reduction to revenue, but the other aspects of the variable consideration model really don't contemplate communication to another party in terms of determining whether you're going to be giving a price concession, et cetera. I mean, some of the examples, like example 2 in the standard, that's the prescription drug example, there's no communication to the other party that you're intending to provide a price concession. So as Brett was saying, for this particular piece of the model, for consideration payable, we're saying that communication matters, but for other aspects of estimating the transaction price, it doesn't. And that's, I think, where the conflict comes up.
Is one of the struggles here, at least as I think about it, is the one model, I think you have a history, say, well, that's part of the implied contract.
Yeah.
And sort of absent the history, or when does something become part of the implied contract? And I think maybe we put a rule here that sort of says absent a history or other factors that says it's part of the implied contract, don't assume it is until you communicate it. I mean, is that one way to think about, is we're struggling with what is the implied contract? Scott?
I think there are plenty of other places in the standard where communication matters, right? We don't have a contract unless we've communicated, right? And I think it's exactly as Jim said. At what point do we account for something other than what we have accumulated? Most of the variable consideration situations that we're dealing with, the whole arrangement is communicated to the customer. It's just we're trying to figure out how uncertain events are going to play out and what that will do to our consideration. The customer knows that if we finish by X date, we get a bonus, and if we finish after Y date, we pay a penalty. There's nothing to communicate. It's just a matter of how we think it's going to turn out. This is really a situation where we're saying, at what point should we account for something different than what's in the contract? And I think that is difficult, and the staff has laid out a suggestion that what the standard says is either when the customer has a valid expectation that something different than what's in the contract is going to happen, or when we actually tell them something different than what's going to be than what's in the contract is what's going to happen. It's basically saying when everybody knows that the contract as originally written isn't the way it's going to play out. Tom?
It seems to me that what we're focusing on is Clause A at the top of page 14 here, and perhaps ignoring Clause B. Because Clause A has to do with the customer having a valid expectation. And that can be either from customary business practices, published policies, or specific statements. And specific statements could be communication. And that's what we're focusing on in examining the example in paragraph 34. But Clause B gives another thing to think about. Other facts and circumstances indicate the entity's intention when entering the contract with the customer is to offer price concession to the customer. So at that time, if the entity's committed to but not communicated the intention to do so, it would seem to be they meet B. And what some of the people are saying here is it should be committed to. And I think that the focus on just A and communication misses the full guidance. And there is room for communication, commitment, but not communicated commitment, still to drive reporting that net. And so perhaps we could describe that better in a memo like this as a conclusion.
So I agree with most of it, but I actually thought this issue was B. I thought because you had a history, then if you had a history in ordinary course of business, you'd meet A, and this is only when you're in B, and the debate is what do you need to be in entities' intentions? And some people say you never have the intention until you commit by communicating, and others say, no, once you've committed at the entity level, communication is perfunctory. And because other places in GAAP, I think we say you have to communicate before you have the liability.
Why I thought it was A, and Sean's nodding, it was about A, is A takes the focus on what the customer knows, not what the entity knows, what the customer knows. And even if there isn't a customary business practice or published policies, then it says it's a specific statement. The only way the customer would know a specific statement is communication. But I think it's go ahead, Sean.
I want to say we are factoring in for sure. We're trying to in this example is B is obviously have to meet B, and it says indicate entity's intention when entering into the contract. And so we said at the date that they entered into this contract to sell, they didn't have the intention. But if they had the intention, they had this planned coupon drop from the moment they signed, then yeah, you would have to account for that. It'd be variable.
Greg?
I mean, so the comment there is entering into the contract is italicized in the paper. So entering into the contract, to me, when we looked at it, was not that gray area. That's the period of time between entering into the contract and January 2nd, right? I mean, that's the focus of our concern was that gray period, that period. Because we literally read entering into contract means the day we enter into the contract.
Oh, Darryl.
So I understand we're talking about timing here and sort of practically how to determine when this decision has been made to drop a coupon. I just wanted to think about it at a little higher level from the standpoint of to the extent that we're considering this to be variable consideration, then I kind of went back to the constraint language a little bit to think about that we would recognize revenue only to the extent that it's probable that a significant reversal would not occur. So I wondered if instead of thinking about trying to home in on when are we going to reduce the revenue, rather to think about it, can we assert that it's probable that we won't do this, such that are we comfortable enough that this coupon drop is not going to happen such that we wouldn't take it into consideration. And I just think maybe that's a little different twist of the way to think about it that might be a little bit more consistent with the overall variable consideration guidance.
I personally think that makes sense, Darryl. And one of the first comments that you made, Allison, was something along the lines of, is it possible that if you followed the staff's interpretation, you'd end up with a result that's completely inconsistent with the overall principle? And I guess I potentially could see a couple of examples that way, but broadly speaking, if you're determining what the timing is to recognize this consideration payable to a customer, and you are really concerned that you're overriding the principle, that might be a pretty good indication that, well, there probably is maybe there is an expectation here. Because how many circumstances are there where you have no past history of issuing coupons, your customer has no expectation of that whatsoever? I mean, I realize that could happen, but you think it's going to be that frequent where it's literally going to boil down to an assessment of the date? I don't mean
that's
to
being redirected to me. I mean, I don't know that I could say that I don't know that I could say that it would be rare. And I appreciate as accounting professionals, certainly as auditors, of course we would be thinking long and hard if we thought something was overriding the standard. I mean, certainly the benefit of having the public discussion here is to help make sure that everybody is oriented in thinking about these things the same way.
Marty?
Well, I was just reflecting on a comment about auditability of this, and I think the way it's written, for me, my perspective, it's more auditable, that it is either when you enter into the contract or when you communicate. From an economic reality perspective, in terms of how much revenue should you really have at the end of the period, if you've made a decision at what Russ has often said with the appropriate authority, the board, whatever it is, to to give a price concession before the end of a period, I think that better reflects economic reality to reduce the revenue at that point in time. But I think it's more of an auditing challenge. It's more of a documentation challenge to demonstrate that we are going to reduce our revenue at this quarter because of this decision. So decision accounting is often more challenging. I think this one is clearer in this case in terms of does you either recognize the revenue reduction at the contract date or you recognize it when the customer has a valid expectation. So I think this is clearer the way it's written right now. Russ?
I had one slight change in fact pattern. So those of you that want to reduce the revenue upon the entity's intention based on management, the relevant authority who has it, not wait to communication, would you have come to the same answer if the company in the prior quarter had recognized the revenue? So the example presumes you haven't recognized the revenue yet, but in a situation where you've already recognized the revenue and in a subsequent period, management decides to do the coupon drop, and then in another period they communicate it, how important is communication when you've already recognized the revenue? To the same thought?
I thought this example presupposed that they recorded the revenue already.
No, they haven't. I mean,
same quarter.
You haven't reported that quarter yet.
Yeah, no. So I mean, it's a later of model. So the later of when I book the revenue, or when I, in this case, when I drop the coupon, is how it's articulated, right? Later up.
No. My fact pattern is, let's suppose in December I sell the product. There's no coupon drop. Mm-hmm. In March 31st, management decides to do the coupon, and they communicate it on April the 5th. So you've already recorded it in December 31st, right? Does the fact that does communication now matter? And it gets to not recognizing revenue versus recognizing a liability. It's to Scott's point. Sometimes when you recognize liability, you want more assurance of your intent than when you aren't recognizing a transaction to begin with. And I just didn't know if that at all mattered if you'd previously recognized the revenue. It should be the same thought process.
I mean, speaking from my own reaction, speaking plainly, I guess I would want to record that as soon as I knew it, right? It's a downward adjustment of revenue, so affecting revenue I've already reported. So it's the same analysis.
Same thought process. Doesn't matter. Okay.
Rita?
You're on.
Ditto.
Okay.
As soon as.
So, Brett, is that takes you to just treat it under the variable consideration model? And I think maybe this won't come up significantly, but I guess if you sort of look at it as it's a subsequent decision, so don't do it till it's communicated, versus you put it in the entire variable consideration model, is if you actually have this fact pattern occur and there is a subsequent adjustment that you didn't know about it as an entity, you change your intent 3 months later, it sort of suggests you should have never booked the revenue because you obviously didn't meet the threshold of not probable of a significant revenue reversal. So it's going to, I think, practically lead you to situations where it's big, having to justify why you booked it in the first place, versus a model that says, look, I never had the intent. The contract was the contract. I have a model that says I don't book it until I communicated it. So it seems to put some restatement tension in the.
But I guess to Darrell's point, you create a tension point there with the constraint, right? Have I recorded more revenue than I expect to be entitled to, and from that perspective, and do I need to constrain it? So I have to think about that, and I also have to think about is it really a consideration payable to a customer, or is it in fact just a price concession that I'm granting the customer? Another way to motivate the sell through, let's say, or whatever I'm trying to do. So I don't know that it necessarily creates tension around did I misreport revenue in day one based on that decision. I guess to me it's just a question of what's the right timing for recording a subsequent adjustment to revenue that wasn't anticipated on day one.
Hal?
I agree with Rita. I think you want to have more of the association of the change with the intent and reflect it at that period. But if we're trying to get to the auditability issue and we keep talking about communication, before you communicate, you generally have a plan to communicate. So does that help if you move it a little bit earlier? Did the staff think about plan to communicate? Because now you've gone from developing an intention to a more firm communication plan, which then gets you to the actual communication. Does that help with the auditability and also help Rita's issue of moving it a little bit closer to a firm plan to communicate?
I guess we didn't spend a lot of time talking about that specifically, but it still seems like it's going to be tough to say, when do I officially have a plan to communicate? Like, what do I have to have scheduled a press release? Or
I think most companies would know when they've put a communication plan together. Maybe being married to a communications person, I think about these things a little bit more. But I mean, they map these plans out pretty far in advance, and they know when they're going to do what at specific dates and times. Just a thought.
Jim, what I'm sensing is a supermajority of the TRG group believes that the interpretation of intention should be when management, the relevant authority, has made the decision, not when it's communicated. So I guess I wanted to test that, and then if that's the case and board members are not uncomfortable with that, is there additional activities we need to do?
The guidance as issued says the entity pays or promises to pay. Well, I don't know how you get to, if we want to keep those words as is, I don't know how we get to you're thinking about it or debating it.
So those that want to do this before communication, is it that you think you can interpret the existing standard to allow you to do that, or do you think you need an amendment to get to what you think is a better economic answer?
I think the latter, unfortunately.
Russ, I think what I've heard this described a couple times, and it hasn't quite come out explicitly in this manner during this discussion, is that changes in the transaction price guidance would seem to tell you that whenever you have a change in circumstance or an expectation, this is in paragraph 3242, that's when you should be adjusting your transaction price. And that exists over the entirety of determining the transaction price, of which consideration payable is just a subset within the overall transaction price guidance. Therefore, that paragraph we carried in from EITF 019, the one that says the later of revenue or whatever, can be viewed as in conflict with this overriding change in the transaction price. And therefore, if you want to get to this changes in transaction price guidance covering the entirety of what is underneath the transaction price, we may need to delete the paragraph that's specific from 019 because it doesn't quite fit the way it used to under the fixed or determinable model.
It does seem to be an odd piece of guidance if we don't mean to wait to the later of, to have guidance that says wait to the later of. I try and summarize this issue. I think, and perhaps it's one we, thinking out loud and giving exciting and fun opportunity to the staff. That the first issue, I do think we were talking about the same outcome, at least within a high degree of agreement, but I don't think A or B perfectly capture that, and trying to take an articulation of that, and it perhaps we can do it in the minutes process, perhaps we need a subsequent paper for the TRG to discuss. I do think that the second two issues, we've got some input, but just thinking as one board member, I don't know that we have enough clarity around it to say the standard will be operationalized with a sufficient degree of certainty or not. I just don't know, and so perhaps a little bit of taking back what we heard. Can we articulate that within the confines of the standard, first of all, to a point where we have a mutuality of at least general understanding, and if not, then whether we need to do something. So perhaps a subsequent TRG discussion taking on board the input that we have. Is that? Yes, Tom.
That was sort of where I was leaning, but I wanted to also put into play, if you really don't know about the coupon at the entering of the original contract, and there is no communication, wouldn't Clause B be when you decide internally that you are committed to the coupon, have you enter into a new contract, because the coupon could be considered a contract modification that changes the transaction price? And I'd just like to suggest at least we contemplate whether
I think that's fair in the confines of the discussion and then squaring that. Can we square that with language that says it's delayed or of, or is there just a conflict that we need to resolve? I mean, you know, in a standard setting way. Is that a fair summary of the discussion? Okay. Let's take a 15-minute break. During that, our staff will coordinate with the IASB on what they heard on these issues.
If they're on a break.
I think they are.
There.
So let's go ahead and get started on issue 4. Mary will tee up issue 4 for us.
All right, thanks, Jim. So there's a question that arises in how to account for revenue and costs from activities that occur prior to the point when the criteria for identifying a contract in paragraph 606.1025-1 are met when the result is that a good or service is transferred to the customer as of that date. We refer to that throughout the analysis as the contract establishment date, or CED, as when those criteria are met. The first issue relates to how you recognize revenue arising from the pre-CED activities. There's 2 alternatives that are in the paper. Alternative A is that revenue should be recognized on a cumulative catch-up basis, reflecting the performance obligations that are partially satisfied as of the CED. Alternative B is that revenue should be recognized on a prospective basis beginning on the CED. In the paper, the staff analysis notes that the core principle of the standard is to recognize revenue to depict the transfer of promised goods or services to customers. And if an entity has transferred promised goods or services within a performance obligation to the customer as of the CED, the staff think it's appropriate and consistent with the core principle that the entity should recognize revenue to reflect the promised goods or services already transferred to the customer. That is alternative A, to do a cumulative catch-up. Issue 2 relates to how an entity should account for fulfillment costs incurred prior to the CED. For issue 2, there's 3 alternatives in the paper. Alternative A is that the costs are capitalized as costs to fulfill an anticipated contract. Those costs would be expensed immediately at the CED if they relate to progress made to date because the goods or services constituting a performance obligation have already been transferred to the customer. The remaining asset would be amortized over the period which the goods or services to the asset relates and will be transferred to the customer. Alternative B is that such costs are capitalized as costs to fulfill an anticipated contract and amortized as the entity transfers the remaining goods, so on a prospective basis. Alternative C is that those costs cannot be capitalized because they're related to progress made prior to obtaining the contract. On this issue, the staff paper discusses that alternative B would not be appropriate in the context of the recommendation on issue 1 that you would do a cumulative catch-up, so to be consistent with that methodology. And that issue A would be the appropriate alternative here, that you capitalize costs as to fulfill an anticipated contract with an immediate expense of those costs if they relate to progress that was made before that date, recognizing, though, that some costs may not satisfy the criteria in 340.40.25.5 for recognition as an asset. For example, general administrative costs, wasted materials, or other costs that wouldn't meet the capitalization criteria, and those would be expensed when incurred. So with that, we'll discuss both issues 1 and 2 at once, and we'll open it up for discussion.
Brett?
We thought we agreed to the staff's analysis here. We would be in a cum catch mode here when in fact the contract starts. And on the second issue, we agree that if you don't, the costs don't otherwise qualify for capitalization, say, for example, is inventory already, and therefore they're sort of in that catch-all fulfillment cost, but that it makes sense to capitalize them based on an anticipated contract as long as recovery is probable. So we would be in the same place as the staff on that one as well.
Brian?
I don't know. One of the examples in there is on a contract manufacturer where they've completed some goods and they have some in WIP. And it led me to wonder a little bit. I think sometimes in that industry you have arrangements where maybe you have an agreement with a customer, they're going to give you a non-binding forecast, then they're going to issue purchase orders that only become binding maybe after like 15 days before delivery. And so the contract manufacturer will begin manufacturing the goods prior to that 15 days. So I guess I was interpreting that situation to say, well, you know, you started performing against the purchase order and you don't have a enforceable right to payment yet. So I think I would think most of us would agree, well, then you have to recognize you don't meet the overtime criteria. You'd be recognizing revenue at a point in time. In the paper, differs from that fact scenario in that you began without a contract to manufacture goods, and then you got a contract, and now you're going to get an accounting outcome that is better than the person who actually had a contract. It's just a little hard for me to reconcile that with View A.
Do you get an outcome that's better than somebody that did?
First scenario, you began manufacturing goods before the purchase order became firm. So they placed an order, but they didn't provide you an enforceable right to payment that came 15 days prior. If you begin manufacturing before that, that means you're beginning to satisfy your performance obligation. And if they terminate for convenience at that point in time, you would not have an enforceable right to payment. So I think you would be recognizing revenue at a point in time. In the scenario that's in the paper, you begin manufacturing goods without even having a contract. And then they show up with a purchase order. And now suddenly you're in the overtime model. You're going to get their recognized revenue, you know, on I would say, sooner than the first scenario I explained.
That's true of the overtime model for contract manufacturer in general, though, right? If you determine let's say you determine you're a series, so you end up in an overtime bucket for a contract manufacturer. As you start to manufacture the widgets or whatever they are, you would start to be able to recognize revenue versus if you're at point in time, you have to wait until the end. So I guess my point is I get your point, but you're talking about arrangements that have different economics. One is a scenario where you will recover your WIP, you will get a margin on those items, and so you're starting to recognize revenue essentially immediately.
I guess I'm not seeing the difference in the economics. I could say, yeah, in the economics is you're manufacturing a good without an alternative use. Whether you have a contract or not, why would you even do that unless it was implied you were going to get a contract? The economics are exactly the same. You're engaged in an activity where you do not have an enforceable right to payment.
They can't be identical because otherwise how could one end up being a point in time and one being overtime? There must be some.
I just described it, Colin. Exactly the same economics, different accounting outcome.
Right. If you have a contract but you're producing to fulfill more than the amount they've already ordered, then you are operating under a contract, but you don't have an enforceable right to payment. Ergo, the literature says point in time. Here we've got a situation where we're saying you actually started producing before there was any kind of contract. And now we're saying once you sign a contract, that's the first point at which you evaluate it. If it's overtime, go ahead and take the rateable proportion of the revenue. I think Brian has identified something where the result seems a little bit odd. Doesn't make me disagree with the staff's analysis, but it does, I think, give you a very strange situation. You have a contract, but they're not committed, so you get point-in-time recognition. And then here you don't have a contract at all, and therefore you get some cumulative catch-up revenue once they are committed. It's
so what you're saying. So if you have a
No,
contract,
you do have a contract in the scenario. They issue a purchase order, but it's not uncommon for the purchase order not to become firm as non-cancelable until like 15 days before delivery.
Right.
you don't have a contract
Yeah, you
pursuant to
do.
the standard.
You don't have a contract.
Not for the excess.
Not for the excess.
Right. Not for the thing they're not firmly committed to. You don't. Do you think you have a contract under the standard for those that you're not firmly committed to?
So then what we have is a contract modification at the time they purchase the optional goods. Didn't we discuss that already?
Which seems like, at least potentially, when they purchase the optional goods, you do the same thing as if they didn't have a contract and do the cumulative effect, or the cumulative catch.
That would be
the
the
same
answer.
outcome.
That would be the answer to Brian's question.
That's what I would have thought. Mike, did you have?
I was just going to say, I mean, we agree with the staff, and in our industry, in defense, particularly on international, this is not an unusual situation because you have to go through all the contracting hoops and deposits that you may start on a contract before it's legally binding. And, obviously you have termination for convenience, so once that contract is signed, they owe you the work that's been done. So I think this staff analysis makes sense, and we agree with it.
Anyone else? Okay. Move to the next issue. Andy, yeah. Andy's teeing up warranties.
Paper 29 addresses warranties. The new revenue standard provides guidance on evaluating whether a warranty is a performance obligation. A warranty would be a performance obligation if a customer has an option to purchase a warranty, such as when it's separately priced or negotiated. Additionally, in certain facts and circumstances, a warranty that provides a service in addition to the assurance that the related product complies with agreed-upon specifications would also be a performance obligation. To make the evaluation if a warranty is a service, the standard includes three factors included in implementation guidance in paragraph 606.10.55.33. There's one issue in the staff paper, and it's how to evaluate whether or not a warranty is a performance obligation if it's not separately priced. The staff's analysis considers those three factors, and there are some other views that were considered and rejected. With that, I'll turn it over to the TRG for discussion.
Mark?
I mean, maybe we missed the point of this, but is this just clarifying that there's going to be more performance obligations out there than today? Because to the extent a warranty includes other services, that those need to be separated out?
I think the main purpose of the paper is educational.
Okay.
Things have changed. It's not bright lines. You need to think about the factors. So,
and it's not suggesting that just because you call it a lifetime warranty that I mean, you could have things that are lifetime.
no, the analysis is by no means suggesting just due to the duration of the service that it's de facto a performance obligation.
We agree.
So effectively, warranty accounting itself is effectively unchanged. It's the scope of what gets into a warranty.
I think we're also trying, just to be clear, trying to highlight a little bit more to your question to Andy, that certainly clearly one of the factors is length of the warranty coverage, so I would say that it's fair to assume that if a lifetime warranty is more likely to be a performance obligation than one that's for a few days or a few months, but that in and of itself is not the reason that the example in here is concluding that you have an additional performance obligation for the warranty. So
no,
it's a combination.
It goes
of the
back
fact.
to think about the service that you're providing. What are you receiving as the customer? And also, it just so happens for this example, it's lifetime.
But in just, I mean, I think we agree. Is there some fact pattern or some articulation of this that we're missing? Was it? I mean, someone submitted this thinking that it was.
I think there are views out there, perhaps that nothing has changed, and I think it was more. I think we viewed it as an opportunity to provide some education, thinking about the guidance that's in the standard.
We have heard some stakeholders just broadly say nothing has changed, and it depends on the circumstances. For a lot of companies that have a very basic warranty of 1 year, 2 year, probably nothing has changed. You still have to consider the factors that Andy mentioned, but for a lot of companies, it may well be that nothing has changed. But broadly speaking, it's not fair to say that absolutely nothing has changed in the revenue recognition model.
So would it be helpful for the TRG to express the sort of confirmation that this is an area where judgment will be required? I mean, I think there's sort of, you run the risk of diminishing returns with going any further than that. In this case, I think the standard lays out some factors to consider, and I think that's to us at least, that's the way you would approach this area, and I'm not sure there's much upside in doing more than that. So I guess if it's helpful, for the TRG to express sort of agreement with the notion that standard requires judgment, and what would be helpful here, I guess, is my question.
I think that's right, and I think the lifetime warranty on a piece of luggage example is a good one, where perhaps people did warranty accounting for that in the past, and you had a product that wouldn't last a lifetime, potentially, and saying, well, you can't just default into warranty accounting. You have to, are you providing a service beyond the definition of a warranty? Although I take the point that just because you express something as lifetime doesn't mean it's an indicator, not absolute. Somebody that sells a diamond and warranties it for a lifetime that it will not break, perhaps is okay. Now, if they're warranting loss or other things, then perhaps they're not.
Is part of the concern that there's no one ever returns them? Or wouldn't that come into the standalone selling price would be pretty small, potentially even immaterial?
Just to see if I understand correctly where the staff is going here, we're dancing around, if there is a service. So I'm trying to think the nature of the service in the luggage example. The service is insurance. Is that right? Not necessarily insurance within the context of the insurance standard in accounting, but that's the service we're talking about, right? Okay.
Or you sold multiple pieces of luggage.
Well, could be that as well. But I mean, to me, I think that's the big deal here. I think everybody would know that if you sell a car and it's got a warranty, and the warranty includes maintenance services, I think we all understand the maintenance services are a service that you'd have to deal with. I think the more difficult question is how you think about the potential of an implicit insurance element, i.e. insuring against future damage as opposed to anything that was wrong with the manufacturing or the product upon delivery.
Russ?
I don't think there was any intention with this, just the reference to services, and I know that's what's in the standard, but I've seen some fact patterns in the past where you've got some consumables that you're guaranteeing for, let's say you're guaranteeing them for 20 years, but they only last for 5. So we've looked at that and said, okay, so you've embedded a supply contract effectively into the warranty. So it's products and services in some cases. I'm sure we didn't intend to limit it to services, but just wanted to make that point.
Others? Moving right along. Should we move on to issue 6? Back to you, Mary.
Thanks. In the next agenda topic, we'll discuss some questions related to significant financing components. In Step 3 of the new revenue model, an entity determines the transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring the promised goods or services in the contract to the customer. In determining the transaction price, an entity considers the effects of various items, including the existence of significant financing components. The new revenue standard includes guidance about how to determine when a significant financing component exists and how to account for significant financing components. This guidance represents a change from existing GAAP and general practice under IFRS. Existing U.S. GAAP and IFRS include guidance about accounting for the time value of money in a revenue transaction. However, the new revenue standard includes more guidance on the topic than existing standards, in particular because it applies to advanced payments as well as payments in arrears. In the interest of time, I'm going to group the questions for discussion. We'll start with questions 1 and 2, which relate to determining if a significant financing component exists. I'll tee up those two issues we can discuss. Then I'll separately tee up issues 3 through 6, which relate to some narrower questions in terms of how the guidance should be applied. So with that, the first two questions relate to determining if a significant financing component exists. Question 1 relates to how should the factor in paragraph 606.10.32.17c or 62c in IFRS 15 be applied in determining when the difference between promised consideration and cash selling price is not related to a significant financing component. The staff paper describes the stakeholder interpretations and the staff's view that those interpretations are opposite ends of the spectrum of how one might interpret the guidance, such that the board's intent may be best characterized as something in between. Determining whether a contract with a customer includes a significant financing component is a matter of judgment, both in determining whether a financing component exists, and if so, determining the significance of the benefit that the financing component provides to the customer of the entity. It's important that all entities analyze the facts and circumstances in the arrangement and applying the guidance on significant financing components to determine if one exists. Question 2 is if the promised consideration is equal to the cash selling price, does a financing component exist? The staff paper describes the difference, if any, between the amount of promised consideration and cash selling price as a consideration, not a presumption in determining whether a significant financing component exists. The guidance specifies that an entity should consider all relevant facts and circumstances. And with that, I'll turn it over for discussions of questions 1 and 2.
Brett?
I guess it's difficult to answer this one in my mind because it's asking sort of how broadly something should be interpreted. In this case, it's an exception to the standard lays out a model for accounting for significant financing, and then there's certain exceptions or outs, if you will. And we're asking, I think I have it right, we're asking how broadly we should apply the notion of an out. And then, I read the example 30, which talks about an advance payment and might be structured for reasons other than financing, and it lists things like to maximize profitability, taking into consideration the risks associated with providing the service. Customers tend to use the service more if they pay monthly rather than making an upfront payment. I guess that's kind of a breakage concept. So it lists a bunch of things that that refer to what appear to be somewhat broad explanations for how something might not be a financing. So on that part, so answering the question, it feels like it's closer to the broad than to the narrow, but I'm not sure what to do with it because at the end of the day there is a requirement to think about whether there's a financing either way. So again, just in terms of being helpful here, I don't know how best to capture that. The staff expressed it as somewhere in between. So it's kind of like the Goldilocks sort of approach here. So I don't know. It seems like if I read that example in terms of advance payments, it feels pretty broad. It feels like there might be, it's sort of like there's a higher hurdle to prove it's a financing in a sense, and that there may be, certainly for advance payments, there may be a lot of ways out. On the other hand, for payments in arrears, I guess, we've heard companies say things like, well, we do that for marketing reasons. Well, okay, well, the incentive is to giving the customer the advantage of paying it late, paying it, in arrears. So, it's hard for me to say, well, a payment in arrears that one feels harder to explain. So what reason would you give for the customer paying slower, right? It's just harder. So advance payments, I guess I think of it as the standard seems to provide a pretty broad framework for getting out of that, but I guess I'd be a little bit harder for me to accept that it's really there's some other explanation for a payment in arrears.
And I guess just to clarify, as we move through the discussion, we're not necessarily looking to opine on view A or B, is it broad or not. I think we're just trying to talk about there's criteria. How do we think about those? How do we interpret them, acknowledging that there's judgment here? So we're not necessarily looking for a black and white answer.
Yeah, I think Brett, you articulated it as clear as this is written, and I
think that was an insult.
And I think you say there's ways to get out, and equally there's ways to get in. So I think that this is probably pretty much the reason why this was brought, that we're looking for areas where there's going to be diversity. This is an area, and I think what this says is we're just going to accept that diversity. But clearly there's going to be ones where it's obvious, and then there's going to be others where I can read example 30, like Brett was saying. I mean, people look at one little fact in example 30 and say, well, that's your out. Other people say, well, I read it this way, and I'm going to get in, so I'm going to gross up my revenue and put a bunch of revenue in. I think it was clear when the boards discussed this that there were differing views amongst the boards, and this was written in a way that if you want to gross up revenue for advance payments, you can do it, and if you don't, you don't have to. So I think that's where we land on this, and if that's where we land, that's fine. But I think we're going to have quite a bit of diversity if we leave it as is.
Mark, what you said sounds, to me, that sounds pretty broad. I mean, what you just said sounds like if I take a car from you today and I'm going to pay in 3 years, that you can elect whether to account for a financing or not. I don't think it's that.
I think it's more around the advance payments.
I just, perhaps useful just because that was something of a broad statement. I think you're correct if you assume that the staff, when we were writing this, couldn't come up with a clear line for you, because I don't think there was really one envisioned. But if we could try and give you a little something more to shoot at, it would be that, we don't think view A, as it was articulated to us, was necessarily correct, because clearly the board intended that timing of payment terms was not to be the deciding factor, it was to be a factor. Conversely, in view B, I think it was somewhat clear that not only did the boards anticipate that there would be reasons, but not every reason would be good enough to conclude that there was not a significant benefit of financing. But there's another part that talks about that when you're considering whether there is a reason for the difference in the timing of payments, for example, it should be proportional to the extent of that difference. Now, again, what is proportional? We understand that, and there's going to be some judgment in that regard. But we don't think that there's no guidance that tells you, to some extent, that clearly there are some reasonable reasons that you're going to conclude that there is not a significant financing component, but that is not carte blanche to, for example, exclude all advance payments, because you can come up with any reason in the world. And that will involve, you're right, some judgment.
I've heard people look at example 30 and they say, well, there's a sentence in there that says you don't have the option to pay monthly. So that's definitive, that if you don't have the option, if you do have the option to pay monthly, then it's a financing. What I hear the staff saying is use judgment, and someone could read it to say, I do have the option to pay monthly, so therefore I got to impute financing, and someone else has the exact same fact pattern, and they don't. And I think that would be fine.
So,
saying under this.
If you think that's a problem, do you have a solution to address it? So would you suggest that we say you always account for financing, or you never account for financing, or given that we're somewhere in between, not just observing it, but do we have, if there's something missing in the staff's analysis, how could we improve the articulation?
Yeah, you're asking for my personal opinion or our firm's opinion, and I think we provided one in the comment letter, but you land it where you are. So now you're asking, is it clear, are we going to result in diversity in practice? I think we're just saying, or at least our firm's saying that we think there will be. But if that's acceptable, that's acceptable.
Do you think we have a problem with that example? Do you think we meant that's the definitive characteristic, or it was just something that one of the characteristics?
Personally, I don't think. I think I could read it both ways.
I thought View A and View B, as articulated, were sort of both looking for a default. Do I start assuming it's a significant financing component and need evidence to get over it? That's one view. Or then the other view is, or do I start assuming it's not a significant financing component and then I need evidence to make it one? And I think the staff is saying neither. There is no default. The standard says figure it out. Don't assume one and try to overcome it. Just figure out why you did it. You did it. You put it in the contract. It didn't exist that way in nature. It's in the contract. Figure out why and account for it that way. That seems quite appropriate to me, and that's certainly the way that I thought the standard was meant to be read. I don't think it's as broad as Mark seemed to suggest, and I don't think Mark quite meant it this way, but it kind of came out like the standard says do whatever you want. No, I don't think the standard says that. It came out that way. I don't think the standard says that. I don't think anybody really thinks it says that. Sure, there's going to be diversity, but I think what the standard says is figure out why it's there and account for it appropriately. And that it doesn't seem like we can do much more unless we are going to, as the staff says, draw a line. And I think we concluded throughout multiple exposure drafts that drawing that line was not going to give us good results in a lot of instances. So we'll have to let judgment be applied and see what happens. It may turn out that down the road we don't think judgment is being applied in a professional and reasonable manner, and then we or Jim may have to do something about that.
Russ or other, I wasn't here at the time, but I actually thought this wording came out of a workshop with preparers and auditors.
That's what I recall, and similar. I thought the end result was what Scott said, that not every timing difference between selling or recognized revenue goods and services and the timing of cash payment was related to financing. There are very valid business reasons as to why the timing of cash does not tie directly to the timing of revenue, and you need to look at it. And we sat around this room, and I thought we worked through what I thought was a solution. So I would be honest with you, I was really surprised this came in. But that said, if this isn't the workable solution, then we need to work to come up with what is the workable solution.
And as I recall, that discussion came in the wake of, I forget if it was the first or second ED, which basically did have a default, which was everything's a financing arrangement, and people said that wasn't workable. And so as opposed to sort of whipsawing back all the way to the other default, I think we tried to get somewhere in the middle.
Russell?
Yeah, I was part of those discussions, and I recall the discussion being along the lines of you generally know it when you see it, and I think that's true for the most part for these arrangements. I think there obviously there's going to be some on the fringes that you have to really apply some judgment to, but I think for the most part people know when they're providing financing and when they're not. So I think the staff's view is, in the way they've articulated it, is appropriate.
Allison?
I think it is helpful because I think as people are trying to get their arms around evaluating whether a significant financing component is present in an arrangement, I think there is some tendency to try to determine if there's a presumption in the model, so I think it's helpful. The model clearly doesn't say one, but I think it's helpful in this paper to reiterate that point. On issue 2, because I think Mary had teed up both issues 1 and 2, so I actually had a question with respect to issue 2. So that's the one where we're trying to evaluate whether the cash selling price and the promised amount of consideration, if they are the same, meaning like in a 0% financing type arrangement, is that indicative of whether a significant financing component exists? And the staff's analysis, I think, appropriately says, well, it's one of many things. You can't just assume that because those two numbers equal that there isn't a financing component in the arrangement. I think that makes a lot of sense. My question arose around paragraph 26, because I think that paragraph introduces what I just said and then says that you need to evaluate the remainder of paragraph 32-16, which is criteria B, 1 and 2, the expected length of time between when the entity transfers the goods or services and when the customer pays for them, and also the prevailing interest rate. So as I was reading paragraph 26, I was expecting a little bit of discussion on that, and I got turned around a bit with some of the discussion about, well, if the list price, the cash selling price, and the promised consideration are all in fact equal, that might indicate that the contract does not include a significant financing component. So I guess I got a little bit confused. On the one hand, we're saying, no, you need to evaluate the totality of paragraph 32-16, but that criteria B wasn't part of what was articulated here in the second half of paragraph 26. So I wanted to ask that question.
So what we were trying to get to is that it's not a presumption you have to consider everything that's there, but I think we didn't want people to take that out of context. I mean, that we're saying that if they're equal, you can't still conclude that there is no financing component. I don't know if I had too many double negatives there, but we're trying not. You have to consider it all, but you still might conclude that there isn't a financing component there. So.
Sure, and I would agree with that. I think it was more just the references to list price, cash selling price, and the promised consideration, kind of linking those three things together. I think that's similar to
concrete.
It sounds fairly concrete, and so perhaps again.
We can make that clear in the summary.
That would be helpful.
Mark?
I just wanted to react to something that Brett said, and maybe Mark Crowley said it in a different way. But if people had a different reaction to the point about whether it's more, in issue 1, more about advance payments versus payments in arrears, I'd want to hear it. I think what Brett said is it seems to be that you get more, I'll call it, I think you used the word outs. You get more outs if you're in advance payments than in payments by arrears. And I think, Mark, you were implying that the diversity might be more around advance payments, too. And if others disagree or agree with that, I would just be curious to know if we're really just talking about more in the advance payments world.
Brian and then John.
Go ahead.
Well, I mean, maybe to add a little more color on Brett's comment, I think there's what the standard says, and then there's human behavior. So I think as accountants, if you're going to make revenue higher, that maybe the threshold for that would be higher. Whereas if you're going to make revenue lower, then maybe the threshold's not so high. I would just say I think over time, with this guidance and the standard, the approaches taken here, that will probably manifest itself over time through interaction, within preparers and their accounting staff and their interactions with their auditors, and eventually, interaction with the SEC and our regulators.
I look at environments where, under long-term contracts, and particularly substantial long-term, very typically you have extended periods of time where the contractor has overbilled the owner and has a significant contract liability on the books, and that may exist over a substantial period of the contract. And it would seem in a strict reading of the standard that it would say, hey, you've got a financial benefit occurring to the contractor as a result of that activity. But I do believe that the outs for coming up with a meaningful reason for having that overbilling will be significantly demonstrated, some of them legitimately and others to achieve a purpose in reporting. So I think there's a lot of, I agree, Mark, with the concept that there seems to be more flexibility for coming up with business reasons other than a financing when there's an advance of funds to the entity through contractual or other arrangements.
Mike?
And I don't know if that's bad or not, but it's just going to create more flexibility and a more diversity in reporting.
Yeah, I'd just say there's a lot of reasons that you get advance payments, especially if you're dealing in a country that has its own laws and regulations, and you go significantly out committing procurements beyond what you've actually incurred. So if you were terminated, your goal is to get whole. And, you know, in places that have monarchies, even the laws there can be changed, right? So, you know, I think on the advanced side, you got to look at it in that context. And then on the other side, you know, there's legal withholds for delivery, like on U.S. government contracts, where until you deliver, the U.S. government doesn't pay you the final 5 or 10%. So I think, you know, to Russ's point, I think we've looked at it and we've seen, hey, there's really valid reasons for these cash incentives that are out there. And there's very few times that you'll have something that's an embedded financing where your customer didn't have enough money to do it. So you said, hey, I'll come along and, you know, in the interim, spread it out over 5 years versus the 3 years of the contract. Those are pretty easy to spot and understand, at least in our industry. So, you know, I think back to the original question, you know, is a bright line desired? I don't think so, because there's too many different arrangements out there. And if you make it one way or the other bright line, you're going to end up with accounting that doesn't make sense. But as a practitioner, I believe we can apply it and use reasoned judgment.
Russell?
Yeah, I don't think there was a bias towards providing outs for advance payments. I think it's just the reality of getting advance payments from customers is really hard. I mean, how many of you auditors are able to get paid in advance for your audit services, right? So if you were able to get paid in advance, then chances are it was for something important, you know, something that was contracted for. So I think this just reflects the reality of how it really works.
Yeah, I wondered if, I mean, there might be more circumstances in which you don't determine there to be a financing component in advance payment, whether that's more outs or not, wasn't clear to me. There also seems more risks in the contract at that point in time versus you've completed it and now the payment extends. The risks associated with operating in foreign countries or the risks associated with significant internal development that you're saying, look, if you cancel this, I want to be at least whole for costs incurred, or other reasons that if you're in that fortunate position to be able to force that payment might not be financing related. Robert?
About this is to actually all transactions have a financing component, and we actually call it working capital. And it's industry specific. Some companies, some industries, the working capital can be negative, some it can be positive. Analysts spend a huge amount of time figuring it out. And if what you're going to do is spend a whole lot of time worrying about what would be working capital, it's not helping us. And I think it's really that it's those other transactions that clearly are a financing are the ones you need to carve out and show. And it really doesn't matter from a user point of view in the gray zones. Because they'll get captured, hopefully it'll get captured in your working capital analysis, and that has to be funded through everything. So it's really, it's focus on getting the most of it right, and at the edge, from our point of view, it doesn't matter.
Jim?
Yeah, I had a similar question about paragraph 26, like Allison did. And as I was looking at that, I was trying to think of how often do you have a situation where you come up with the opposite conclusion. So, and maybe if the staff is going to clarify that paragraph later, that might help. Alternatively, are you aware of, are there lots of examples where all three prices would be the same and you would conclude there's significant financing? Because if there's a lot of those examples, it might not hurt to provide one.
I think one aspect, looking back at how we worded this end of that paragraph, one of the things we were trying to get at was there's a little bit of emphasis on whether the list price, the cash selling price, and the promise are all in fact equal, because some of the scenarios that we've had batted around, people are taking, for example, a list price and assuming that's the cash selling price, and therefore our point that we were trying to get to is that in some respects, it may be, given it's one of the two indicators in 32, 16 or 17, one or the other, if you actually, in fact, have this scenario rather than faultily somehow making a faulty conclusion that the list price is your cash selling price, that might actually be an indicator that there isn't a financing component. But the fact remains is just because you have a list price that says something and you theoretically say that I sell it for X hundred up front or X hundred over time doesn't necessarily mean that would actually be your cash selling price, absent other factors within the contract. So some of it was about trying to put a little stress on that conclusion as much as it was about the words. And I grant that may not be coming through as clearly as we intended.
Yeah, I just want to, when we're talking about advance payments, everyone's trying to get the out. And I understand, John and Mike and Russ, you guys want the out. You don't want to have to deal with the financing. I guess it sort of sounded like, clearly there's not financings. It sounds like that's a broad interpretation. There can be all kinds of reasons why you get the out. So it seems like in those circumstances, we would object to someone that wants to get into it, right? Or it just sounds like everyone says it's so clear, so therefore you wouldn't. I just want to make sure that we, and maybe I'm beating the dead horse here, but everyone that wants to get an out is trying to get one, so they're going to get it in advance payments. I guess if it seems like if we want consistency, or at least try to limit the consistency, I assume people in those situations cannot account for them as financings, but. I guess, are we saying that they could if they wanted to?
Mark, I've always said that, there's good business reasons to get an advance in the context of a long-term contract, and then there's immoral billings that occur. So I think at the extreme, there are going to be situations that are truly financings that go on that you can't justify with the rationale of good business practice, but in the main, my view is that the preponderance of transactions where there is an advance funding, there are adequate business purposes around the risk of the transaction to have that. And it's normal and customary in the industry as well. If it was a one-off, I would have a different view, but it's ordinary and customary that's the way it's structured.
And don't get me wrong, I'm in the same view, but
Right.
I just want to make sure that we.
So, Mark,
I'm in the same view. We've talked about this before.
I'm with you. I think if people are across the board on advances in sort of A&D or construction, recognizing revenue, and saying they're really loaning their customers money, that's kind of a weird model to be in because that's not really the model that we're in. So, like loaning the U.S. government money or loaning foreign governments' money is not really part of our model. So I think if you're increasing your revenue from that, I personally would be skeptical. Anybody who brought me that and said, hey, I want to recognize revenue for this and it just, or money being lent to us, recognize revenue.
Yeah, so I take it's the extremes would be where you get to gross up revenue, but not any. But I don't know whether folks on the other side of the aisle, they're not here. But
is question 3 related to? I personally don't believe it's optional to just say, well, I've looked at the substance of the transaction and everything, and I don't think it's a financing, but I'll do it anyway. And I think that might be the question you're asking. I don't think that's optional. I thought question 3 was asking, you've concluded there's a tiny financing, but the standard only makes you do significant. And so do we want to preclude where management and the auditors conclude there's a financing, but it's immaterial or it's not significant? I thought. So I thought you were asking a different question what question 3 was.
I wasn't. Yeah, I'm not asking question 3. I'm just asking. It's just sort of. It seems like you could argue for the same fact pattern, 2 different answers.
Can you help me with that fact pattern? Because I don't think I don't see how you can ever argue in Michael or John's fact pattern there's a financing in advance payment with the government. I just don't. Based on my knowledge of that industry, I just don't see how you argue it. You seem to say that you can make any argument, you'll be okay. I just
not with the government. I mean, if I get an advance payment, say take example 30, and I get an advance payment for 3 years worth of service, or they could choose to pay monthly. Is there financing in there? Disregard whether it's significant or not. Example 30 states that you don't have the option to pay.
So Mark, are there missing words that would help you, or are you just saying we should create a bright line? I mean, I keep hearing you say, well, somebody might, on the margin, somebody might reach different conclusions, which begs that we either need to articulate it more clearly or come up with that bright line.
No, No, I just want everyone to know that there's going to be diversity, and that we don't. I mean, everyone seems to be implying that everyone will come to the same answer. I just want to sort of make it clear that there will be diversity in this.
But it's not just an election that you take whenever you want it. There may be some diversity.
Right,
But your statements are as if anybody could justify anything, and I don't think that's the case.
Yeah, and I think that has me concerned. I don't think the boards are intending for there to be a rule, so I think there's acknowledgement that there'll be diversity, but I don't think the boards are saying, well, in any situation where you have a significant advance payment, you could call it a financing component, or you could try to justify that it's not, if that's what you choose. I don't think the boards are ever intending it to be an option. I think they're saying you use judgment, and your judgment tells you what it is.
I'm just saying two reasonable people can come to different answers on this. So that's fine.
Yes.
As long as we all agree, that's fine.
I was just going to make some related points. I guess not. Even in a construction environment, I can imagine a situation where you might have had, say, a thinly capitalized company who said to the customer, "Look, I can't access the banks. I need, pay me all the money up front, or pay me a big chunk of it up front." Where we might look at that and say, "Boy, it feels like financing." And I'm not saying that would happen often, but in that scenario where you had where there was express need to be funded early, I think we might think, boy, that feels like a financing in that case. The ones to this point about kind of know it when you see it, I think the ones that I've been thinking about that are going to present a challenge are kind of these one-off transactions, say a license arrangement where either you're paid all the money up front and you've concluded it's an overtime recognition model, or vice versa, where we're going to have to figure out what's going on. Why is it or isn't it a financing? Again, I think the standard says what it says, and we'll deal with it and have to apply judgment. But it's going to be a challenge in some of these areas. So just
and sometimes
go.
Having been involved in some of those, there's indicators like if you pay up front, the price is this.
Correct.
And if you pay overtime, the price is that.
Right.
That might be an indicator that.
But if they say I paid up front because I wanted the customer to pay it up front because I didn't want to take any chances. I wanted them to have more skin in the game. Whatever their explanation, it just might be, it might be in that case a lot. I'll say easier, if you will, to argue the out than in the inverse. And then on the second issue, I think we talked about this point about the cash selling price being the same as. And I think the problem is, there are actually real world transactions. Call it the sofa sale in the furniture store, or the handset, where the price, the upfront price and the overtime price are identical. Part of the reason that that's the case is that the customers that tend to opt for the upfront and don't want to bother with paying overtime, they don't want to bother with the administration on that, so they're willing to pay a premium effectively. And the customers who opt for the overtime are the ones who need the financing. And so the contracts might have a zero interest rate, and it might even be stipulated or might be set out as a financing. So, in those cases, it feels like using the financing model makes sense. And I think where the staff's headed, to me, is logical. But I just, again, there could be situations where everything does line up exactly. You just have to think about the fact that, these customers actually needed the financing, and that's why it was provided. So.
Jim, on that one, I think all I would say is sort of repeat what Scott said, which is that sometimes maybe we're bringing together the list price and the cash selling price as if it's always the same thing. And I think what the staff is saying is the list price might actually not be the same as the real cash selling price. There might be an implied discount rate in there, and we shouldn't use list price and cash selling price interchangeably. And maybe that's something we need to articulate a little more clearly.
And I can see, I wouldn't want people, in Brett's example, to conclude that just because somebody doesn't take advantage of it and you can show that the cash price is this doesn't mean somebody paying over 5 years isn't taking advantage of significant financing. Probably harder in the current interest rate environment to figure that out. But
keep in mind, those are the same customers that have the higher credit risk, so the model would have you carve that out at the implicit rate, or So.
Move on to the next. So the remaining questions in the paper relate to some narrower scope questions about how to apply the guidance on significant financing components. Question 3 is, does the standard preclude accounting for financing components that are not significant? The staff view that's outlined in the paper describes that we do not think it would be precluded. Question 4 is, should entities determine if the practical expedient can be applied, or how should entities determine if the practical expedient can be applied in scenarios in which there's a single payment stream for multiple performance obligations? In the paper, we included an example with the different views and our thoughts on those views. Question 5 is, how should an entity calculate the adjustment of revenue in arrangements that contain a significant financing component? In question 5 in the paper, we've pointed to the other gap in IFRS that would tell you how to do so. And then on question 6, how should the significant financing guidance be applied when there are multiple performance obligations? The staff paper includes a view of how you piece together the guidance to get to that answer. So with that, I'll turn it over for discussion on those 4 topics.
Anyone? Looks like they agree. Any disagreement? No? Oh, sorry, Catherine.
Not disagreement.
Okay.
Just with respect to question 6, we wondered if it might be helpful to provide an example on that, just so people could see the mechanics, where you're trying to allocate the consideration to multiple performance obligations. We also wondered if it might show some unintended consequences that you wouldn't think about without seeing the numbers. And maybe you've already done that. But
one concern, we actually did consider doing that, and I can imagine that a lot of companies, particularly private companies, are going to go ask their auditors, how do I do this? My own personal worry with doing that was if Mary had put together an example of this is how you will do it, then people might look at that as that is the one and only way you must do it every time. And would we be introducing complexity into some of your accounting by Mary giving an example? And I'm certainly open to your input on that. Since I'm looking directly at Jim, I wonder if maybe something like the AICPA would be a better forum to give examples, mechanical examples of how one would work through this. But sorry to put you on the spot.
Yeah, no, I think that's a fair question. I had the same observation. This seems like it could be a very complicated model, but maybe you're right. Some of the industry task forces could come up with the examples that one could turn to then.
You look, Brett.
Yeah, just on the last question, I don't. To me, there may be various approaches that are used to come up with this, to solve for this. But one of the things that's come up in some of our industry discussions is the question of whether one has to do the allocation of the transaction price, sort of, I'll call it on a gross basis first, and then discount back, or whether the discount is in fact part of determining the allocation to this, to the element, to the performance obligations. In which case, it sort of requires an iterative process to come up with the solve for it. And I think people are looking to figure out if there's some ways to, mechanics on this to kind of come up with a reasonable workaround. But again, I suspect that in a lot of these areas, the standard doesn't really tell you how to do it, and people are going to have to come up with, reasonable approaches. And so I tend to agree with not going too far in this area. But that's the one question around the mechanics that we've gotten.
I just wanted to be clear. It's my understanding that the determination of whether there's a significant financing is made at the contract level, at defining the transaction price, and not down at the performance obligation level. And I just want to be clear that we're not inferring that if I make a determination at the contract level that there is not a financing, that I then have to go through some secondary process down at each performance obligation to determine if there's a subset of financing that happens to occur on one of those. And I just want to be clear that once I pass that contract threshold, because there was the discussion of this topic just brought me back to, was the staff believing that I could have a financing at the performance obligation level, and I had to assess it at that level.
And that wasn't the intention of issue 6. It was more once you've identified it at the contract level, what do you do next?
Where
We weren't implying that you have to.
Does it get allocated to all or one?
Yep.
Okay.
I just wanted to comment that we've spent a lot of time with thinking about the significant financing component and how to do it mechanically. The guidance in question 6, as simple as it may be, to just back out the financing component first, is so helpful for people to understand, because if you're trying to embed the financing in the accounting model, you run into this simultaneous equation question and issue. It's really hard. So, clarifying that this is how you do it is a huge benefit and should help people out a lot.
Anyone else on this issue? Okay. Oh, one more.
Jim, let me just add one other thing. I have seen some situations where there may be transactions where there are multiple performance obligations, but those performance obligations defined by the entity have no relationship to a specific billing to a customer. And so we've got a lot of guidance on how one is kind of maybe get back to what Russ was talking about, is that we have a lot of guidance on how to allocate the transaction price, but when I send a bill out to a customer, it may not be intuitive of how much of that bill attributes to each of the performance obligations, and there is no guidance on that. So I think there will be, that's another place where there's some holes in the multiple performance obligation, is how to attribute right, dollars to the transaction.
Yeah, to that point, I mean, I think the staff's analysis suggests sort of a pro rata allocation of the cash payments to the performance obligations, if I read it right in that issue. This is a question, issue 4 in the paper.
So on issue 4, I think in that example, we weren't trying to necessarily say how you allocate the cash. It was more so saying taking an approach where you don't consider that might skew, distort the economics of the transaction. So we weren't, I guess it's a different question, so we wouldn't want to take that answer and analogize it necessarily to John's question.
I guess on that point, maybe one remaining comment on this series of issues, but we thought that there were transactions where legal terms, contractual terms would dictate whether the cash related to one versus another performance obligation. And so that was in the first order of, where it wasn't clear. Let's say you sold a handset and provided telephone services, and the cash, it was sort of, you couldn't tell what the cash related to. We tended to agree with that notion of sort of more of a pro rata orientation, but we thought that there could very well be scenarios where you would know actually when the cash payments come in, which performance obligation they relate to, and that you'd start there in terms of the allocation process or the allocation of the cash to.
That makes sense. We were also thinking of scenarios, like Mary said, where it's just not clear which of the performance obligations it would relate to. And in fact, I've personally seen a lot of circumstances in practice where the customer just cuts a check, and it's for you to figure. You don't even know what contract it relates to. Never mind which performance obligation it relates to. But I think what you said, I mean, if you know what it relates to per the contractual arrangement, probably want to think twice about not following that.
So what I think on this issue, I'm hearing that general consensus around the staff paper. I think we can provide some clarification in the minutes, including perhaps dealing with the issue of payment in advance versus payment in arrears. Not that there's different models, but that there might be different reasons one has a significant financing component or not. Taking the points on paragraph 26, I think Allison and others raised. And again, you'll get a chance in the minutes process to take a look at that. We want to do the not-for-profit issue before we break for lunch. perhaps we can do that I'm hoping we can do that in 10 minutes or less.
Yep, I've got
Okay.
that. Thanks,
Thanks.
John. So some stakeholders have questioned whether contributions are in the scope of the new revenue standard, and those that think they are excluded have asked whether the FASB would consider amending the scoping paragraph in 606.10.15.2 to explicitly exclude contributions from the scope of the standard. The new revenue standard defines a customer as a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. And a contribution, by definition, is a non-reciprocal transfer and thus is not considered to be an exchange transaction. Therefore, the staff believes that the receipt of a contribution is not in the scope of the new revenue standard. However, it would still be important for a not-for-profit to consider its other transactions that are not contributions and whether or not those might fall under the scope of the new standard as exchange transactions. So with that, do TRG members agree with the staff's analysis that contributions are excluded from this scope, and also if you believe the standard is sufficiently clear that contributions are excluded?
Brett? Oh, go ahead.
I was just going to say that while I agree with the staff's analysis in terms of the fact that it appears contributions are not within the scope of the standard, I believe that the question is originating from folks that are looking at this not feeling like it is clear, and that the basis for the conclusion seems to be coming directly from the basis, which won't be codified into U.S. GAAP decades from now. And also the preamble to the consequential amendments is providing the other piece of support, and that piece of guidance won't be continuing. So I'm wondering if it would be helpful for this particular industry to have that actually clarified in the standard. Not suggesting that that's an urgent matter. Maybe it's something as part of a technical correction that could be considered down the road. But I do think that that industry feels like it would be helpful to have that explicitly provided for in the standard.
Brett, then Rita.
Yeah, I agree with the conclusion as well, and I guess on the scoping question of whether to scope it out, to me it would have been, well, it's not an exchange, it's a non-reciprocal transfer. So if you do decide to scope it out officially, maybe think about other types of non-reciprocal transfers like grants, tax refund, things that might not, might also be. So there's sort of a risk of unintended consequences by trying to sort of scope out more things that I don't think, in my mind at least, I never would have thought it would have been scoped in. So I know there's a request to do that and make it clear, and maybe the minutes process would achieve that objective. I don't know, but gotcha. Rita?
Sorry. My experience on not-for-profit boards is that there is often a link between the contribution and an expectation of something happening, whether it be naming rights or particular programs that are expected to be carried through. They're in the normal course of that charity's activities, but they're clearly identified, and it's actually part of a marketing tactic that is used to generate contributions. So I was, maybe there's a technical definition I'm not aware of on contribution, but my experience has been that contributions are often linked.
I've talked with at least our not-for-profit folks who are on this task force that came up with this paper. And I think part of their concern in keeping in mind that is that, for example, like if I make a donation of a certain size to like my kid's college, that donation also entitles me to, when I go to campus, I get free parking, I go to a chancellor's dinner, I get discounted tickets for the football team, I get a discount in the student bookstore. And I think what they would like to hear is that, if I contribute $10,000, some portion of that probably is in the standard, but the part that is true contribution is outside the scope. And I'll just, look at this paper and say, is that what you're saying? Or are you saying, no, you characterize as a contribution? And so I think you're just saying just the non-reciprocal part is a contribution. The other part is in the standard, just to be very, clear about that in the minutes.
And I
So you would
think
agree with
that's
that,
what we're
right?
trying to say.
So the only observation I have is if it looks like the TRG agrees with the staff's conclusion, rather than putting a technical change in our standard, because I don't want to start a precedent that says here's the scope, and then here's what's not in scope. I just wondered if perhaps the next time you update the accounting and auditing guide for not-for-profits, if you could view that as an interpretive matter, and that way it would get out to what I think most in that particular sector focus on. And if we all agree that it's not in the scope, I don't know if we need to make a technical amendment, because I agree with Brett. If we start saying everything that's not in the scope, we could make the scope paragraph rather lengthy.
I also I don't think this necessarily solves, Rita, your point that when you solicit contributions, sometimes there can be multiple things going on. I suspect it's already an issue in not-for-profit. I don't know that people are necessarily taking naming rights of a building and saying that portion is reciprocal. So because they have their name on it and they gave $50 million, they would have given $5 million just for the name. So $5 million is a revenue transaction and $45 million is a contribution. I suspect people don't do that, but the gray line between naming rights versus football tickets, this probably doesn't solve for. Jim.
I guess just to respond then to Russ, I think that's a good solution. I know the task force that put that forth, their goal probably would have been to get a technical correction so that it was perfectly clear. But there are clearly nuances and where there's, as you said, both the nature of contribution and revenue. So I think by putting it in the minutes to this meeting, the AICPA can work with it in the guides to clarify the intent.
Okay. Cullen observes that there's one issue left that we perhaps could deal with before lunch. That would allow us then, if you want, we could then try and coordinate with the IASB over an abbreviated lunch period, see if we could at least come back and report to you whether we're in agreement on these issues, what we need to bring back, maybe even get them back on the phone and risk that we could hear them or not. If that's an acceptable proposal, maybe we can go on to the last issue, which Cullen also tells me maybe we could deal with quickly.
Now that you said that, it's definitely.
I just wanted to jinx us. Mary?
Yep. So the next issue relates to series of distinct goods or services. The questions on this topic relate to the applicability of the series provision within Step 2, identifying performance obligations. In order to determine whether or not the series provision applies, an entity must have already identified the promised goods or services in the contract with the customer and determined that two or more of those goods or services are distinct, because otherwise the goods or services would be accounted for as a single performance obligation. There's two questions included in the paper. Question 1 is, in order to apply the series provision, must the goods or services be performed? Must the goods be delivered consecutively or services performed consecutively? Question 2 is, in order to apply the series provision, that is, to account for an arrangement as a single performance obligation, does the accounting result need to be the same as if the underlying distinct goods or services were each accounted for as separate performance obligations? The staff paper describes that the boards provided two criteria to determine if the series provision should be applied, and that criteria is included in paragraph 606, 10, 25, 15, or paragraph 23 of IFRS 15. Those two criteria focus on whether each distinct good or service meets the criteria to be satisfied over time, and whether the same method would be used to measure the entity's progress towards complete satisfaction of the performance obligation. The standard does not include a requirement that goods or services be performed consecutively, or that the accounting result needs to be the same as if the underlying distinct goods and services each were accounted for as separate performance obligations. So with that, the question for the TRG members are if you agree with the staff's views in the paper, and with that, we'll open it for discussion.
Allison?
I wanted to comment. I think that it's helpful in the paper because there have been some questions raised as to whether the guidance on applying the series of distinct goods or services language if that's actually required or not. So I think it is helpful that the staff paper makes it clear that it is required. And so because it is required, it means the companies will have to make sure that they are in fact considering it. It isn't as though they could just apply one piece of guidance for getting to a single performance obligation versus the other, and it doesn't really matter which way you get there. It actually does matter, and so companies will need to have controls in place and be able to identify that, yes, they do actually have a series of distinct goods or services. And I think what I've understood from the staff's paper, since the goods and services don't have to be provided consecutively and that you don't have to have the same pattern of recognition that you otherwise would have if you were just recognizing the goods or services individually, that it's a fairly broad scope in terms of what could be a series of distinct goods or services. So again, I think that's important for companies to take into account when they're identifying performance obligations. And then my last observation related to the consecutively delivered goods or services, I think it's also important, assuming the staff would agree, that if you don't have something that's being provided consecutively where the pattern of performance may be different, then that doesn't, a company shouldn't just think that they've got a series of goods or services and that you can then recognize revenue ratably over that period of performance. If you're not performing or providing the goods and services consecutively, that probably is an indicator that your measure of progress for that performance obligation should reflect the fact that there is a difference in the timing of the pattern of performance, and the revenue recognition would not necessarily be straight line. So those are just a couple of observations. That's all.
On the series concept, I think my understanding was it was set out to make it easier to implement the standard for companies that had sort of repetitive services and the like. So the daily cleaning service that you could look at as a single performance obligation and avoid having to think about allocating consideration to separate performance obligations. So I think the point that Allison makes about it being a requirement. So set out to help companies, but it's a requirement. So if you qualify for it, you're in it, and you have to apply it. And I think it's created noise or tension, and we hear different fact patterns that people are sharing with us that where they believe that they think they might be in, they're not sure if they're in, or they think they should be in, but we're saying, well, we don't think you're in because. Like the standard says this example with electricity that gives that, that because electricity can't be stored, presumably, and it's delivered, it's consumed immediately as it's transmitted, and so it qualifies for the series. But if you're delivering oil and gas that couldn't theoretically be stored, well, that's not in the series guidance, even though it feels like the contracts are very similar and, might be the same sort of motivation in terms of looking at them as a series. Conversely, we've heard companies who think, boy, this wasn't really meant for us, but we do things consecutively. Or we, say take a 3-year auditing services contract where you might say, well, I'm in there every month delivering auditing services. Was the intention to be in the scope of this series, or was that really was that 3 separate performance obligations, or maybe 1 performance obligation for 3 years of auditing services, let's say? So all that being said, it's created all this sort of concern around we think we might be in scope or we want to be in scope and we're not sure, and the answers are going to be different if we're in scope in some situations. So just wondering if there's any thought around maybe to remove some of that pressure by saying, look, this is a practical expedient. You need to qualify. You need to have consecutive services or goods that qualify for overtime recognition to be in scope. And they need to be, whatever consecutive means. And I think the staff's sort of saying that we're not going to tell you that it means this or that, but presumably if there's a big enough gap of time between things, then it might not be consecutive. But it just seems to me that it's created this on top of evaluating whether I have a single distinct thing or whether it's integrated unit. I now have this extra piece I have to think about, and it's created a lot of questions.
So just to clarify your point, you're not necessarily disagreeing with the staff today that it's not an election or an expedient. It's an ask of, hey, this was put out to be simpler for those who do qualify for the scope. So it's a request to consider whether we want to make it an expedient.
And the basis actually says, I think the basis describes why it was laid out as, but it seems to be described as a requirement. And
yeah, I got you. Mike?
So the only thing we had was a bit of difficulty with example C, and wondered if it really conflicted in any way with BC 112, where you had a single performance obligation, or the deliberations that'll go on related to distinct. And so we kind of certainly in our own, industry, could have had a different conclusion or seen a different conclusion there. And I think, as the exposure draft comes out, just cognizant of these examples may be different than what's in there. So, I didn't know if there's better examples than what's laid out in example C, but we didn't necessarily conclude that it was not a single performance obligation in C to start off with.
Yep. And in example C in the paper, we weren't trying to, take that further than just the series provision. It wasn't intended to contradict what was previously discussed with performance obligations. I think that the difficulty with this is, you have to be over time to even get into this. So coming up with a scenario where you're over time and you have a difference in the pattern of recognition, we were just trying to illustrate how you might think about that. So certainly not intended to contradict the prior discussions.
Thank you for the clarification.
I had the same concerns about Mike on the example.
About Mike or the example?
Both. But I do have concerns about the paper in general, or the concept. I do remember the discussion a couple of years ago being about your basic service contracts that are continuous or not. I don't know was really that important, but it was when everyday service was basically the same as the next, and the value was the same. You could understand why it would be practical to just look at it as one performance obligation. I struggle with some of the examples, and I get it that the words would lead you to make it broader, but I don't know that was the intent. And maybe we could ask the boards, but it wasn't. It doesn't. At least my recollection was that wasn't the discussion. And the reason that I find it difficult is, in a long-term production type contract, even when you're dealing with a reasonable amount of volume, if you're in one performance obligation, it matters when you have a cumulative catch-up adjustment, and I'm not sure that it's economically makes sense to just do the cut and run analysis that the distinct criteria would put you into. I think when you add a number of units or you have a significant modification, you're going to have it really it's about the overall margin of the contract in our industry anyway. So it's hard for me to think about the series guidance in the context of long-term production contracts, and I'm not sure that it makes sense economically. And it wasn't my recollection of the discussions that we had a couple of years ago.
Brett suggest, again, would that address it? Not saying that the words aren't clear today, but that would seemingly.
Yeah, if it's characterized more as a practical expedient that you could avail yourself of or not, I think that would be helpful. Yes.
Brian?
Yeah, I would reiterate Brett's point in that initially looking at the standard is, it says either, but then there's no or between the two conditions. So you end up with saying this is a requirement. In E&D, I think, if they were unable to conclude they didn't have one performance obligation for whatever reason, this guidance having this series thing available to them is helpful. But I can think of other industries where, I build for a little while, then I build somebody else's stuff for a little while, and then I finish building what they're building, that the series guidance is going to be more difficult to apply than applying for each one individually. So,
Mark says IFRS says or. Oh. Anyone else? Yeah, Mark.
I'll just reiterate, we've had the same sort of discussions around long-term production contracts. So if you're a contract manufacturer for making 3 years of customized widgets, they're sort of looking at this saying, what does it mean? And there's some words in the basis for conclusion that sort of imply that you have to have the same exact price for the whole 5 years for every customized good. But, depending on where this lands, I mean, it sounds like this clarifies it, what the intent was, but I think a practical expedient, I think that people would welcome that.
We'll have to figure out how to capture that in the summary of whether we should include then, and interested in your views, a TRG recommendation that it be moved to be an expedient.
I think
Scott?
in favor of that.
So before I would feel comfortable weighing in on that, I think I need to understand a little more about why it wasn't made an expedient in the first place. I mean, I think the intent clearly was to make it simpler, and I think in most of the cases it will. But the boards didn't make it an expedient in the first place. They made it a requirement, so I think I need to understand a little more about why that is. I admit that in these situations that Brent and Brian and Mark have pointed out, I'm not sure I see that it would actually be harder accounting for it as a single performance obligation rather than multiple. So I'm not sure I understand what the benefit would be of calling it a practical expedient over what we've got now.
Just maybe one additional thought, I guess, in terms of what source of confusion. And that if you think about it right now, the scope of it is services and goods that are qualify for overtime, which is the no alternative use. And so that's the sort of broad scoping that you have to be in it, right? And then it has to be a series and with the same similar pattern and all that. So again, if you think about it, well, that puts a lot of pressure on what's a good versus a service too. If I sign a 3-year arrangement to provide meals on a military base, I describe that as provision of food, right? Is that delivery of a good, or is that a food management services contract? And you get into all these sort of esoteric discussions that frankly shouldn't matter, but yet by saying this is a requirement coupled with, okay, well, is it a series or not? Well, reasonable people can differ on what. So again, I think that the idea would be it would be a change to the standard, but the idea would be to take some of the pressure off that distinction by saying, look, if it works for you, if it reflects your accounting, then that's great, but if it doesn't, then.
So I think we can provide some clarity through this. Perhaps we could also work offline to figure out the ramifications of if we were to make it an expedient, some of the simplifications, but to Scott's point at the same time, look at the original decision and what other ramifications it might have. And maybe that's a way to capture it as we can provide the clarity here, and we'll look into issues associated, not committing that the board would do that, but issues associated with treating this as an expedient.
To be clear, it's not necessarily that it's harder or easier. It's the issue that it gets a different answer potentially, and it creates sort of this tension that.
Well, yeah, I mean, one of the issues you don't have to go through the esoteric. Then, if you just don't want to avail yourself, if we were to make an expedient. Okay, why don't we break for lunch, and then during lunch again, we'll try and get a sense for where the IASB is at, whether we can bring the meeting back together or just report back to you.